we have like 100 questions or something that I'm going to go through and pick the ones we can answer. Typically, we don't get anywhere near 100, so we're going to see what we can get through today. And yeah, so to start, I'd love you guys to introduce yourselves, to tell everyone what you guys are up to, what you guys have done, and why they even want to listen to you. Other than you guys are my friends, and we hang out. Yeah. The funny thing, so a bit of background on myself. My name's Luc Boiron. I am a wholesaler and a house flipper and real estate investor of other sorts. Between my wife and I, we have about 100 rental units, with 4 of those being Airbnbs. And we also wholesale a couple hundred houses a year. We've bought and sold over 700 houses at this point. And I've been investing in real estate since 2007. What is that? 15 years? 15 years, yeah. So yeah, been around a bit. I was a lawyer, left law to get into real estate full time, and that's actually when real estate really blew up for me. So currently, yeah, we run a wholesaling business. That's this company, Bliss Realty. If you guys get wholesale emails, we're investing Bliss, and the whole point behind selling wholesale deals is to try to get discounted properties to investors so that investors can make money on it. So that's a bit about me. Alex and Ryan here are very experienced and sophisticated investors, and they're also friends. Alex also does the occasional realtor work, but don't ask him to do that for you. But he did just sell a house for me in Hamilton yesterday, acting as my realtor. Usually his amazing wife, Kaylee, sells our houses in Hamilton, but this time it was Alex because, well, they have 3 young kids, and recently
for second best, it seems.
Pretty much, but you did a good job. We got in this market, so a little teaser on the can flipping work. We flipped a house in Hamilton, and we just sold it 50,000 above asking in this market yesterday. So it can still work. Does the chat work for everyone right now? He's testing. I can chat.
There we go. Should be good now.
Chat's working now.
Found it.
So now, if Alex, if you want to introduce yourself, and in the meantime, if everyone wants to drop in the chat, where are you guys tuning in from? Love to hear that.
Yeah, awesome. So my name is Alex Powell. I'm a real estate investor, predominantly in the Hamilton area, but we work from Brantford, kind of Welland. I currently have a portfolio of about 87 units, and so we also do fix and flips and a lot of joint ventures. We've done the odd wholesale deal, but we don't really focus on that. And of course, as Luke mentioned, we have a real estate license as well. We also have a property management company called Solutions Property Management. And so that's very exciting. And my background was actually in mechanical engineering. So I left my job and I got my real estate license to start learning sales. And from there, I kind of left my real estate agency job to keep doing investing, which is my true passion. That's a little bit about me.
Yeah, and for those who don't follow Alex or haven't seen him post about it, Alex and Kaylee somehow take on some of the most messed up properties you'll ever see. To buy an 8-unit that's leaning over and almost falling over and completely fix it up and make it beautiful, and also make a ton of money on them. So that kind of property, the worst hoarder house in Hamilton, was one of the news articles you were in.
Yeah,
you take on some crazy projects and really make them beautiful, but I also know that you're really good at making money on them. So
you take on a property today, and the lady was super concerned because there was some debris on her carpet, and I don't think she realized we've literally walked around properties with feces on the walls, and this is no worried at all, man. It's all good.
Yeah, so Alex can handle some serious construction projects. I've seen it done. I've seen him do it. So yeah, very impressive stuff. Ryan, also a friend, and luckily Ryan's a friend of mine, and I get to call him up sometimes. I just called him today for advice on a property that was in his neck of the woods. He's particularly he's very experienced in real estate, but particularly good in the Durham region of the GTA, or really all of east end of GTA is kind of where you specialize. Mm-hmm. And so I have property in that area that I knew Ryan would be the best person to call on to get some advice on how to do it. Something we're closing on is another flip in the next couple of weeks. So thanks for your help with that, Ryan. And why don't you tell us a bit about yourself?
Yeah, thanks for having me on. Hello, everybody. For those of you who I do not know, my name is Ryan Carr. I do invest out in the Durham region. I am primarily now more of a land investor. I do have some buy and holds for sure, done lots of those in the past. Been investing since 2012, part-time, and then I went full-time in 2014. In a past life, I was an auto mechanic, and that was cool, but then I realized real estate was cooler, so I ended up doing more real estate than mechanics, and in 2014 ended up going full-time. We've done a smash of deals since then, done some work with TV, wrote a book, have a podcast, and I'm super excited to be here tonight and share some answers with you guys.
Awesome. Yeah. And Brian's basically saying, yeah, he found real estate more interesting than building armored cars.
I did. And armored cars are pretty cool. They were pretty cool. But you know what? We make more money in real estate and I have a lot more fun doing it. So that's why we're here.
Hey, you ever thought of putting armor on your Ferrari?
I have not. I have not.
Probably a good idea. Yeah. So as you can see, they're both really experienced, kind of operate on different sides of the GTA. Myself, I'm based out of Ottawa. I'm originally from Toronto. Our business actually operates kind of across Canada. We're in British Columbia, Ottawa, from southern Ottawa across to southern Ontario across to Ottawa, and we're also in Montreal. But yeah, these guys are based out of different ends of the GTA. They do kind of different stuff, some similar stuff. Actually, Ryan's bought a couple wholesale deals off of us. Alex, I don't think you ever bought anything off of us, eh?
No,
You just helped us sell stuff.
we've wholesaled together. I brought you
Yes,
guys. But
That's true. That's true. So yeah, we've all worked together. It's great collaborating with other investors who are reputable people that you can count on and are honest. So I'm really happy to have you guys there. With all that being said, questions about recording. This is going to be recorded. So we will be sending out a replay in the next few days. So it's recorded and you will get it. Everyone who has signed up on the webinar link will get sent the recording. On top of that, like I said, people who signed up gave us questions. So we're going to be going through those. But if in addition you have any further questions, try to add them in the Q&A, not in the chat box. And we will try to get to some of them, but there's going to be a lot we won't be able to get to. So let me start. Let's start off with one of the simple ones. Someone asked, what is wholesaling?
I think you'd be best to answer that.
I mean, that's what we do. We wholesale. So basically what it is you're buying houses directly from sellers, and then you are selling them before you close on them. So you're selling your right to purchase the agreement rather than the actual property. The benefit to that as a wholesaler is that you don't have to get financing to close on the property. You don't have land transfer tax and realtor commissions. You don't have all the closing costs because you never take title of the property. And so you're basically selling a contract. You're selling your rights under the contract rather than closing on the property and then reselling it. In order to do that, because of all of those costs, you're able to sell it at a much lower price and potentially still make money if you bought it at a low enough price, because all of the closing costs would otherwise eat into profit if you have to close on it. So you're basically buying low, selling slightly higher, but not all the way at market. If a property's worth $100 and you can buy it at $80 and sell it at $90, that's kind of how you make your spread as a wholesaler. And as a wholesaler, you don't really make money if you buy a property at $99 and try to sell it and it's only worth $100. You're not really going to make anything there because nobody's going to buy it privately and have to deal with that. Funding can be a little more difficult. There's some differences to buying from a wholesaler. It's not as easy as buying a turnkey property off the MLS, but solving problems is how you make money in this business. So you get a discount there. So some of the stuff about kind of this year coming up, 2023. One of the questions was, what do you think are the hotspots for value investments within Ontario for 2023?
That's a good question.
That's a good question.
I think that I'm more of a fan. I don't know. You mind if I chime in? I still am more of a fan of buying in the larger cities, like for example, Hamilton, St. Catharines. I know, Ryan, you guys are at Oshawa and stuff like that. So I think that those areas are still good. I just think that fundamentally you're always going to make your money on the buy. So I still have a lot of confidence in, Ontario or even Canada as a whole to invest in. I do know a lot of people are starting to head out to head out west, like Alberta, because I think there's a lot of opportunity out that way. We invested in New Brunswick right before the spike hit, which was proved to be very beneficial. So we're very happy with that decision. But even areas like that where, some of the economic indicators aren't as strong as others. Like, for example, Hamilton has a very strong economy, and I think that there's a lot of interesting things that are going to be happening in the coming years that are going to keep it thriving. But I'm curious to see how the West is going to, like in Alberta and in that area, how that's going to work out, because I think there's some opportunity out there for sure.
Yeah, Ryan, you have anything to add there?
Yeah, I mean, for me, I primarily invest up the 401 corridor. So when I'm looking for opportunities, I mean, yes, the market is important, obviously. I'm less looking at market specifics because the GTA is so populous and ever growing and evergreen. I'm less looking at the specifics as if I were to go into another province where you would have to rely on those fundamentals. We just kind of know that in the GTA that things just continue to grow, not necessarily prices keep going up, because obviously we're seeing them go backwards. But I mean, like, just in general, the GTA is a very strong market. Rent ratios are obviously of concern right now with interest rates the way that they are, because the prices are more expensive and the rent doesn't keep up ever. It seems like you're forever chasing it. But I mean, for me, whatever market I invest in, and again, for me, it's 401 corridor, but like whatever market it is, I'm always looking to hedge my bets, and I'm always looking to buy below market value. So like, even if we've seen a 30% retraction in prices, if you bought 2 years ago, you're fine. But like, even if you see a 10% retraction in prices the same year that you buy, if you bought 20% below market, well, then you're still ahead, right? So, I mean, I think it's all relative, really. And it's all about, for me, how do I hedge my bets? If the market goes bad, I say this every time, what's my upside potential and what's my downside risk? And that's what I want to know. And if you're buying below market value, your downside risk is covered, and your upside potential is you get a bunch of money back on a refi.
Yeah. When I look at what kind of the hotspots for value investments, historically, you'd go kind of further out of Toronto. The further you got from the big cities, the better the prices were. During COVID, prices skyrocketed in those areas because they were more affordable to start with, and people could get into remote work. They didn't necessarily need to go into the office. We're seeing a reversal on that, where people are needing to go back, or they want to go back, and that pandemic demand for those kind of rural or very small town kind of properties seems to have pulled back drastically. And I mean, we're talking, they went up, these properties doubled in a couple of years, right? Some of these areas. So I think when you look at the pullback that there has been in prices in 2022, it's not even across the board. Not everywhere has gone down equal amounts. Some areas have probably held their value. And some areas have just held their value better than others, and some have been hit harder. I think the areas that hit harder are probably the areas, for the most part, that went up the fastest during the pandemic. And those were areas that had that demand from remote workers and things like that. So those areas probably were hit the most, and probably still have a little bit more room to be hurt. What I think is an opportunity for hotspots is actually kind of the reverse, because I think right now is a good time to find a really quality property that you wouldn't be able to buy in a hot market, right? You can be a little pickier. You can find that cornerstone piece. I mean, my wife and I just bought my favorite property probably ever. We closed on it in July of 2022. And we seller financed this with this is not common, but a vendor take-back mortgage for 84% of the purchase price for a 10-year period.
Is this the building, the big building? This
is the 24 unit we bought, and it's concrete construction. It's on the 401 corridor. It's a really solid building. That's a building that I want to own forever. I never want to sell that building. I want to own it the rest of my life. That's pretty much the people who sold it to us. That was their only, well, no, it was their biggest building, but and they had owned it, over 30 years. They had owned it, managed it. I plan on doing the same, owning it for the next 30 plus years. So, the market's even changed since then. But that's a property I'm never going to regret having been able to buy. And I actually bought that in competition on the MLS, which I buy most of my stuff privately. I bought that one in competition on the MLS, and I'm very happy with the result. Because of the way the market has been, I was able to get a better deal, and I think that's the case now. So being able to buy a quality product in a good market, before you were fighting over scraps last year. the beginning of 2022, 2021, you're fighting over the scraps. You're getting some properties that, need a ton of work. And you're often not getting the discounts. I know, for example, Alex, when you buy a property that needs a ton of work, you get the discount. But a lot of people, they're buying the property that needs a lot of work and the discount doesn't reflect that. So yeah, now's the time to get a quality property that you're going to want to add to your portfolio and own it for the rest of your life. This is the time to do that because you're not going to see the same competition level and you can pick that out, pick the right property. So
that's kind of how I interpreted the question though too. Like, where are you going to find value investing in real estate rather than, like, I guess the flip side would be like growth investing. But just as you said, you find the right asset that makes sense. To be honest with you, like, I've had a lot of people over the Christmas break come up and be like, are you guys okay with the interest rates? And I'm like, this is kind of Christmas for investors. This is a really, really exciting time to find, properties that, as Luke was saying, we've been fighting over scraps for so long. It's nice to actually like see some opportunities and run some numbers that could actually work, So I think the value is in the buy and to make sure that the numbers work. And if you're concerned about interest rates, just run them conservatively and lock it in, even if it's not at the interest rate you're hoping for, as long as the numbers work.
absolutely.
I think on the residential side, if you look at the price versus like today's price versus yesterday's price, and then you look at current interest rates versus yesterday's interest rates, like it's kind of an inverse relationship. So what's happened was we were high prices, low rates, and now we've swapped over to higher rates and lower prices, but your carrying cost on a monthly is actually identical. It's very, very close. So
But I do find a lot less people are able to qualify, I find. So even
qualifying
though,
still tough, yeah.
even though the price points haven't decreased that much, I know people who would initially qualify like 800 purchase price, and now they're like, they can barely get 500. It's wild.
Mhm. Yeah, for sure.
Well, since you brought up interest rates, one of our questions was about how will interest rates impact your buying strategy? And for those who just haven't seen the news yet, the Bank of Canada did increase its overnight lending rate by 0.25% today. And it did indicate that they're probably gonna, I don't know if I just saw a quick article about it, but if you guys agree with this, but it sounds like they indicated they're gonna wait and see. They're not indicating that they're necessarily going to be raising at the next rate hikes. They're going to wait and see, which most likely with inflation expected to come down. There's a good chance that this might be our last rate hike. We'll have to see as more inflation and job market numbers come in. Anyways, so back to the question. It was how will interest rates impact your buying strategy? Since I'm making you guys go first every time, I guess I'll affect this. I'll answer this. What we've seen in our wholesaling business is a lot fewer investors are looking to buy. And because of that, we're selling less on the wholesale side. As a result, what we've done is we say, well, we've got these great deals. Normally we'd assign it and not have to do the renovations. In this case, we're not finding as many buyers. So let's just take this one down ourselves. Let's renovate this one. Like I said, Alex just sold one of our properties yesterday. We're flipping all over the province. We're flipping houses now. Bit of a spoiler on if flipping works in 2023, but yes, we are actually flipping a lot of houses ourselves. And we're making money on all of them. Again, know your numbers, know what you're doing. I started off with, when I went into it full-time with flipping, moved to mostly wholesale model with a few flips here and there to keep the ability to flip. And now we've moved back to doing a lot of flips. So flipping has changed a lot, but then on the other side, a long-term strategy, I am very cautiously buying. I'm not buying aggressively, but the right properties that come up, it's hard to turn down. We actually recently bought one that I really like in Ottawa. It's a purpose-built legal duplex, up-down duplex. And with the passing of Bill 23, we're going to very easily be able to add a third unit to it. So the plan is to take, it's a 3-bedroom up and a 2-bedroom down. We're going to make the downstairs a 3-bedroom, turn the upstairs from a 3-bedroom into a 2-bedroom and a 1-bedroom. So making much better use of the space. We're going to end up with 6 bedrooms instead of 5, but that's across 3 units instead of 2. So the overall rent's going to be much higher. The garage, large detached garage, is going to be rented separately. And what I really liked about this one too, in relation to the triplex, is that it has it's a corner lot with 2 separate driveways, a double wide on one side and a single on the other. So it's kind of ideal to turn it into a triplex, really. So yeah, that one's again, it was hard to turn down to buy a property like that in the 500s. That's almost move-in ready. The units, one of them is, and so we just need to divide up a unit and add a bathroom and kitchen in that. It's going to be a very reasonable rental cost, and we're going to have a much higher value product when we're done. So that will probably be, if we wanted it to be, we could probably make it into a full BRRRR. By BRRRR is for those who don't know, it's an acronym. It stands for buy, renovate, rent, refinance, and repeat. So that one basically we'll buy it for a certain price. We're going to put money into the renovation, and then we're going to go back to the bank, say, hey, now it's a triplex, it's worth more money, get a new appraisal, and then be able to get, based on that appraisal, borrow based on that, and hopefully be able to pull back at least all of our renovation money out of it, if not much of our capital out of even the purchase on it as well. So yes, the right property we're still buying. And it's hard not to with Bill 23, which we'll get into a little later. I find it hard not to, because it's provided so many opportunities on that people aren't even looking for yet, because they don't even know about it yet. So there's properties that, you know, oh, okay, well, what was its highest and best use podcast? What was its highest and best use before, and now that's changed. And so if there's something where you can easily divide office space, take an addition on a house, turn that into an extra unit where you otherwise couldn't, and again, parking situation allows for it and that kind of stuff. I think if you can turn a property and make a cash flow now in this market, I think rates are going to come back down, and you're going to have much better cash flow down the road. So long-winded answer.
You think rates will come back down to like 2%? Or do you think they'll sort of normalize somewhere between where we are then, or where we were before, and where we are now?
Yeah, I don't know that we're ever going to get rates the way they were. That was pretty insane.
Free money, helicopter money.
Yeah, I don't expect to. So no, I'm not saying we're going to get rates back to where they are, but I think they'll come a little bit off of where they ended up at today with the most recent rate hike.
Yeah. I think they're saying like normalcy is somewhere around 4%. Is that right?
You're talking about mortgage rates?
Yeah, like a typical mortgage rate, long-term trend, something like this. I kind of heard somewhere around 4%. That's sort of where they're tracking to hopefully end up at.
I think so, something like that. High threes, fours, but I guess the target inflation is 2% a year. That's what they're aiming for. I think right now we're at like 5.8. It's come down this last report. So
yeah, I mean, inflation, interest rates have been low. I actually remember the way it came down. I bought my first property in 2007. I believe prime rate was 6%, and I got a mortgage of prime minus 0.75. It was an RBC mortgage, and the way their mortgage was structured, it was my payment didn't lower as interest rates lowered. So 4 years into a 25-year mortgage, I had 11 years left.
It was just like smashing down the principal every payment.
Yeah, absolutely. So that worked wonderfully on that side. Obviously, it hurts when you have a variable and rates are going up. I believe we're at the end of that. You know, again, all of this is informational or educational in nature, this webinar, so we're not promising anything, but I think we're close to the end of the rate hikes, and I do think they're going to end up having to lower it a little bit.
A lot of the indicators are lagging, right? So I almost picture like you know, those minions from Despicable Me, like on a teeter-totter, and they're all like, the Fed is just running to one side and then it starts to tip, and they're all like, oh shit, we got to run back the other way. They're trying to run. So it's always a lagging indicator. And same
That's like the best analogy for it I've ever
heard. That's the only way I picture it in my head. It's like, crap, we have to turn back the other way. So I think that by the time they realize they're going to have to lower it, like we're going to start to see economic indicators that are going to be very prominent, you know, in terms of, you know, recession, what's going on with that, right?
Yeah, I agree. And I've never paid as much attention to macroeconomics as I do now.
Totally, me neither, man.
But when you look at inflation numbers month over month, annualized, the first 6 months of 2022 was something like 12% inflation rate annualized, but the last 6 months was something like 0.3% annualized. Now, typically, the first few months of the year have the most inflation for the year. Those are typically higher, so not necessarily that we're going to see 0.3% annualized, but still, we're trending down hard, and like you said, they may be going too far over on the teeter-totter, and they may have to overcorrect to stimulate things again. So it's going to be an interesting balance.
the bond yield has decreased. Like our fixed rate mortgages are actually, they're coming down right now. We're just going through a refinance. And during this process that we've been waiting for like our commitment from the initial estimate on like a 3-year fixed, our interest rate actually came down on when we actually signed the paperwork, which was like a very pleasant surprise. But yeah.
All right. What do you guys, let's go back to that question. Is flipping dead in 2023?
No.
I don't think it's dead. No, I don't. Well, you're like, Luke, you've been obviously very successful in your flips. I mean, you're probably you're doing the most flips out of anybody out there. You know, like you're crushing it, right? So I think flips are very much still alive. Do you have to be like cautious as heck? Like, yeah, you do. I mean, especially at the peak, like right at the peak, I got dummied on a flip and that sucked. You know, that was the first time I had ever lost money on anything, really anything real estate related. And I got hit, but there's nothing I could do about it. And even though I bought right and the renovation was on point, like everything was good, it was a textbook play, the market fell apart. And like, how do you overcome a 30% drop in like 6 weeks or whatever it was? It was so fast, right? So if you buy wrong, you're going to get smashed. If you get caught in another downturn, you're going to get hit again. So, I mean, if prices have sort of somewhat normalized and we're going to see some level interest rates, I think people will probably, generally speaking, be fine as long as you buy right and you buy with enough margin that if the market does recede any further, which it very well could, then you're still safe, you know, and you get to play another day. But if you buy at market and renovate to market and sell at market, you're actually backwards by, you know, a significant amount. So definitely hedge your bets on the bottom end and you'll be good.
Yeah.
Actually, it's a very good good sharing there, Ryan, because when we turned around to right at the peak, we had a flip that we ended up losing, I think 15 grand on. First time I ever lost money on a flip as well. But actually it was a conversation, Luke, you and I had, and you reflected on a time where something similar happened, where things had changed. And you're like, don't wait, pull out, best thing. Because I look at it now, I'm like, holy smokes, like I would have been hurting if I didn't like just cut my losses, accept the fact that it's you know, just take what I can and go from there. And it actually didn't end up turning out to be that bad. So when you compare across all the wins we've had across the last little while, but you know, I think that all those points are exactly on point. If you buy right in this market and you buffer, you're not going to sell in a week, you know, everything that you put on the market. But there are strategies that you can do to set yourself apart from some of the competition out there. I think a lot of people got really used to just throwing up properties with like cell phone pictures and they would just sell in multiple offers. Nowadays, maybe budget an extra $2,000 for staging, that kind of thing, to kind of set yourself apart. And then another thing to think about is like maybe have a plan B. That property doesn't sell as a flip, maybe you just keep it as a rental. Maybe you can add an extra unit that you didn't initially budget for, but you can then create into something a little bit more useful for the time being.
Mm-hmm. Sean Allen, hi Sean. He just chimed in and said buy extra low. Like that's truth. That is your hedge, right? And Sean's flipped lots of houses. That is the hedge. That is the bottom line. That's your prevention against loss, and that's also your upside if everything goes to plan. So I mean, I agree.
Well, and Sean's actually flipped, like you said, a ton of houses.
Yeah.
There must be. He's flipped a ton of houses, and he does a lot of larger projects. And he's just come back in more recently and started flipping more houses again. And I would say, yeah, Alex, we had talked about that for everyone else. In 2017, I lost 90 grand on a flip in Whitby. Ooh, that hurt. Oh, that hurt a lot. I learned a lot of lessons from that one. I'm a lot more careful on what I buy. One of my lessons was speed, because in a falling market, you don't want to be chasing prices down. So like mentioned Alex at the time, it's better to cut your price, sell it quickly and move on. And if that means taking a loss on this, it's better to take a small loss now than a big loss later. Sure. Yeah.
Hey, to that point, just because you can renovate something doesn't mean you should. It's a big difference. So like you can put in like all the quartz and the granite and the pot lights and all this and make it gorgeous, amazing. But just because that's an option doesn't mean that's what's going to actually return. Like if you're going to spend $1, let's make sure you get more than that dollar back, or don't do it. and I think a lot of people can get pressured by sales agents, or they can get pressured by friends or family or ego or all of these different reasons to say, look at this property that I've built, I'm amazing, beat my chest. And it's like, okay, cool. It's maybe it's beautiful, but you spent 6 months longer than you should have and you broke even, as opposed to just maybe doing something light and simple and moving on, or not doing anything at all and turning it over and making a little bit instead of trying to go for the grand slam. So again, just because you can renovate something doesn't mean you should.
Yeah, absolutely. I mean, when the market was going up, 10% a month, it seemed like at some points, it was probably a good thing to be flipping slowly. Like, hey, I have contractor delays. Wow, okay, I made more money. That's not necessarily best practices, but that's what was happening. Market was going up so much that it would cover your butt. Now you have to be dialed in. I mean, the property I was talking about, even though this isn't a flip, it's a burr, property I was talking about in Ottawa. I have someone out there today getting permit drawings. I don't close for another, 2-3 weeks, but I want my permit drawings done and ready to submit as soon as we close, to save time instead of closing and then, oh, what do I want to do with this now? No, be ready to go. Same thing, contractors. That was one of the things I lost money on that one in Whitby. I had contractor problems and it delayed me, and I wasn't on the ball as much as I should have been, and time killed me. Because especially when you're flipping with private money, that carrying cost is high, the market's falling, so your loss gets bigger and bigger every month. Make sure you're on top of your renovations. That can be make or break. Be ready to renovate as soon as it closes, move quickly, and get it done fully. Push, gotta push. Hey, we're done today. Oh, perfect. Okay, when can we line up the staging, cleaning, staging, photos, cleaning today, staging tomorrow, photos the day after, on the market the day after that. Let's go. Like, don't waste time. That flipping is absolutely doable now. And you see, like you said, Sean Allen, who is an incredible flipper, he's getting back in the market and doing more flips because it's now more possible than it was to get good deals, but you have to be more careful than you were. You have to run your numbers better. You have to be more on the ball. You can't just wait for the market to carry things up and then sell it at a higher price. It's not going to do that. Okay. We kind of covered this a little bit, but any thoughts on how long the market will be slow?
Gut feel, intuition. I kind of think we're going to see a bottoming at some point in the next 6 to 12 months. I really obviously, I don't know, right? But I think just judging what I saw personally from interest rates interest rates going up and prices coming down, I think when those do start to level off, we'll see an inverse reaction of what was happening to what will continue to happen. It was a carrying cost thing, I think. You know what I mean? Like, clearly, if we have a couple 100,000 people coming into Ontario, whatever the number is, 125, I'm not sure, but all these people coming into the GTA and it's flooding the market, and it's causing so much of a supply and demand issue that, everything is offside and off balance. Like, the market has become very eccentric, and that's why it went up so crazy, because the money was cheap and people needed a place to live. And we had all these people coming in, and it was, oh my gosh. And now money's not so cheap. The pressure's been let off again, but the people are still coming. So, I mean, short-term, long-term, if we're going to go long-term foresight on this, there's definitely still, I believe, for myself, in the way that I'm investing, I believe there's a bull run long-term. Short-term, we're going to see some cycles come and go. But I mean, if you're going investing for the long-term, you're probably going to be okay. At least that's how I see it for me. And I think that when we do see those interest rates come off, I think we will continue to see prices come back again.
I'm curious to see about the spring market. I'm not to be honest with you, I think that there's still a tremendous amount of demand. Like, with that property that we just sold yesterday, we had 57 showings in the span of 4 or 5 days or something like that. And the majority of the agents that I was following up with to see if they're interested in bringing an offer, they're dealing with first-time home buyers. So there's a lot of these, and couple that with the foreign ban right now for 2 years that people they're trying to withhold from people purchasing. What I do think is there's going to be a tremendous amount of upwards pressure on rents. I can tell you that, because people are still coming in, they need a place to live. But I think from a bottom of the market, I tend to lean towards Ryan's analysis there. Is that I think that it's going to be a little rocky this year, but I do think that, especially once the interest rates start to come down, start to increase. And as soon as that happens, you're going to start to see that feeding frenzy type thing happen again. So, that's why even now, if the deal, if your numbers work, maybe don't lock it in for 5 years or something like that. Lock it in for 2 years or a year and see where things go after that.
Yeah, as long as you have the reserves to account for any increases after that. If you really push, then don't take further risks. But yeah, if you have good reserves, then you have the ability to take risks that might allow you to have more upside. Yeah, I think you guys are right. Like, how long will the market be slow? Again, there's so many variables that go into this that nobody's ever to be able to predict when the market's going to be good. Someone was asking earlier, when's a good time for a new investor to get in? Is it a rising market, a falling market, flat market? The problem is you don't actually know. Someone could have been buying in February of this year at a crazy rising market, and then 2 months later, it wasn't a rising market anymore. So you don't actually know what it is. This could be a falling market right now, and then 3 months from now, it might not be a falling market anymore. If I were to bet, which I wouldn't on this because I don't believe I know enough. I don't believe anyone can know this accurately enough, but my bet is it's going to be stagnant for probably the next year, which means, like you guys were saying, up and down. I think we're going to see stagnant. Probably will give us a good chance to have a good spring, like prices going up in spring of 2024. And I don't mind a stagnant market. I've never liked a market that goes up 20% year over year. That's a scary market. It's not sustainable. So I don't like that as a market. So I think we're going to be relatively flat. Probably my guess is probably for the next 12 months, there's going to be good news. There's going to be bad news. It's going to be on and off constantly. And yeah, if there's one thing that's going to kick off prices starting to go up, it's going to be interest rates going down for sure. That's going to help out a lot. So those are my guesses.
We've been getting a lot of calls on like people like in pre-foreclosure. I don't know about you guys, Luke, similar situation. I'm wondering if I don't think that it's that prevalent. I think the rates are quite low of that actually happening here in Canada. We tend to stress test things pretty high, but I'm wondering if there might be a flood on the market too come like the nicer weather once the spring happens, where you start to see, because these things are about to turn around, right? Since the interest rates have really gone up over the last year. Now you're going to have people that are struggling to make ends meet and are just assigned to sell. But if you have too many of those hit the market, that will also affect, supply and demand will work inversely.
Absolutely. Yeah. And I mean, one of the reasons there hasn't been a high volume of sales is there's been low inventory for some reason. People are going, no, my house was worth more before. I don't want to sell right now. And a lot of people are holding out. And some people are choosing to rent their homes. You see properties that were listed, they pull them off the market, they rent them instead. So yeah, I think there'll be good news and bad news. Like I was saying, we'll see how it averages out. It has been surprising. A lot of the stuff you see listed, like you see properties sitting for a long time, so you end up with high average days on markets. When you look at them, the majority of what's listed there is just overpriced. The stuff that sits on the market is just priced too high. Sometimes it's like, wow, that house maybe was worth more before, but right now it's listed at 800 and the comparables sold in the low sixes. They're asking way too much money. If they were priced in the low sixes, they'd sell in a week. So pricing right is important. And you ask too much, you're just not going to sell it in this market. So, yeah. So you mentioned actually the flipping, was it the flipping tax you mentioned? No, the foreign buyer tax, or the foreign buyer ban.
Yeah.
Yes. So yeah, let's talk a little bit about recent government legislation that happened. We have Bill 23 that passed in Ontario. We have the national foreign buyer ban on foreign buyer for 2 years, and we have the new flipping law. Let's start with the foreign buyer ban. I'll start with my opinion on it. I don't think it's going to do a whole lot. There's some markets that are more focused on foreign buyers. You might see parts of Vancouver affected more. What I learned in 2017 when the provincial government created that foreign buyers tax was it matters less how much it will actually do to foreign buyers than the people's perception on it. So I don't, what I've seen a little bit in the Vancouver area is people think that there's a ton of foreign buyers, and there are a decent number, but that they think there's a ton of foreign buyers, and therefore they're scared to buy anything because they think prices are going to crash because of foreign buyers. What I noticed in 2017 when it changes, a lot of people, they go to an open house and they see people who don't fit Western appearances, and they think, oh, that's a foreign buyer. Meanwhile, they're born in Canada, or they have a permanent resident card, or they have a, one of the other exemptions to it, right? So they have a work visa or a student visa, whatever it is. They have a permanent residency. They're Canadian citizens. They just happen to be born in a different country. There's a lot of Canadian citizens that aren't born in Canada. That's part of what makes Canada great. So people have a perception that there's maybe more of the people buying are foreign than they are. They see, an Asian name and they go, oh, that's a foreign buyer. No, they were born in Etobicoke. What are you talking about? But so there's a perception, but then you have to realize that perception also changes the market. So in areas where there's very high foreign buyers, people are going to be scared that, or a very high talk of foreign buyers, there's going to be more fear that the foreign buyers are there. I think Vancouver area might be more affected by it. Whereas the talk I've seen in the GTA, again, this is more anecdotal, but it's been more around, oh, this probably won't matter. They'll probably just find a loophole, probably just, get some dummy corp or something like that. They'll probably find a loophole for it. So not a big deal. What? There's a $10,000 fine for doing it. They don't care, that kind of thing. So I don't know how you guys feel about that, but I don't think in most of Canada it's going to make a big difference, but there might be a few pockets where the perception affects things more than the reality.
Yeah, I'm not really that educated on it. I don't know. Like Jason Lau just said, less than 5% of the market is actually foreign buyers. That might be true. That might not be true. I don't know. I do know that people do things in politics for optics and for votes. And I mean, like, just like when they brought in this new anti-flipping tax, like really, they say, oh, we're going to tax the people for flipping houses. Well, like flipping house is always active income anyways, which is always taxable. So like nothing's changed. Like nothing, it's bullshit. Nothing's changed.
Well, we were going to get to that, but yes, go off, please.
Somebody called me on that today. Like, what do you think about this? And I'm like, it doesn't matter. Like you flip a house.
Yeah,
and make money,
can you explain it? Can you explain it for everyone? So
sure.
For everyone, there is a new flipping tax across Canada.
Yeah.
Explain it, please, Ryan.
Yeah. So the federal government came in and they said, hey, we want to legislate against these flippers, right? Horrible people, the flippers. We're gonna crack down on them and we're gonna like steal all their money back in tax. I go, oh, okay. So everybody pays attention. We wake up, right? And then they come out with this legislation and they say, well, we're gonna start taxing the flippers on the income that they make. And it's like, cool, you're already doing that. Now what? You know what I mean? But for the people who aren't educated in the space, primarily the homeowners and various constituents who see that, they go, wow, this government, whoever you vote for or whatever, like this government is really doing things to help with the price of housing by cracking down on the flippers. And then I take a step back and I go, okay, well, if you're already taxing people, what is changing? The answer is nothing, like fucking nothing, zero, nothing's changing. Okay. And then they bring in the anti-flipping thing for homeowners, which, okay, so if you flip your principal residence less than 12 months, minus like a half a dozen different exemptions or so on, then they tax you, fine. But that's not the majority of people that are making up the market, people flipping their principal residence. And I think the biggest challenge that I have with all of this is that when people look at the government, to create the right answers and to do different things, that's fine. But like when the government then looks at the flippers and says, hey, you guys are causing the housing prices to run up. Well, how is that any different than a homeowner buying that same house that a flipper bought, going to Home Depot, buying all of their same materials, evenings and weekends, or hiring a contractor to come in and do it? Like, how is that any different than the flipper doing it at a net profit? Because at some point in the future, all of the bricks and sticks that you put into that house, whether you DIY or whether a flipper does it, is going to end up back on the market. And because prices trend to go up, that house will be worth more in the future. So like all you're doing is you're taking from the future and you're bringing into today, or vice versa. So I don't buy into this whole thing. It's ridiculous.
I love the perception side of it. It's just like, we're making a difference and everyone's cheering in the background, but there was another rule that came out a while ago about like, it didn't have any effect because, well, for us, we were incorporated at the time. But I forget what the rule was. It was sometime last year. But anyway, I want to go back to the previous question about this foreign ban, if you guys don't mind. But I'm not overly, I don't know too much about the numbers side of things in terms of what percentage of the market that it makes up. But I have heard that Obviously Canada is a very stable store for like a value for your money. So if you consider somebody who's coming from China or from India, where there's likely a lot more volatility in their markets, I would think that coming to Canada and buying a bunch of condos that, despite the market fluctuations, you're kind of a safe haven to purchase. So I don't know how much of that went. It was kind of a very interesting way to consider it, but especially with a lot of the global, I guess, unrest, when you start to look at things on a larger scale. I wonder now, with people still immigrating into Canada, obviously we have pretty high quotas on how many people we're going to be bringing in on a yearly basis, but now none of them are buying. And I'm wondering now, in 2 years' time, when that lifts, like what is going to happen? Because we're bringing, like, what is it, 400,000 people a year? Is that the, like, maybe someone correct me if I'm wrong.
I think it was higher than that.
I think in the next 5 years, it's like 1.5 million or something like that. I don't know. I've lived in that number, but it was a ridiculous amount. And in the next 2 years, that's what I mean. There's going to be a tremendous amount of pressure on the rental market right now. And I think that as soon as that lifts, it's just going to be like a pack of dogs just after some prey. That's what I
Well, I think in general, I don't know, but you guys, I think in general, real estate investors, for the most part, are bullish on the long run, because more people are moving to Canada than we're building homes. There's going to be more and more demand for the limited number of homes that there are. So, I mean, I'd be willing to bet that 20 years from now, 30 years from now, homes are worth more than they are today. The difference is in the short term, right? Like in the short term, someone can choose to rent for a little bit. Someone, people can move in with family and things like that. But long term, they eventually, there's going to be more demand for housing. And yeah, some of those people who are moving in to Canada, recent immigrants, they're going to get their permanent resident card. Suddenly, they're not a foreign buyer anymore. They get the permanent resident card, they're not a foreign buyer. I think there's exemptions probably for work visas. I'm not sure. But yeah, definitely permanent residents become citizens, etc. Suddenly, they're not a foreign buyer anymore, and they're allowed to buy. So it doesn't actually ban all the people you think it's going to ban. Yeah, someone just said those with the second-year work permit can still buy houses, right? So there you go. Yeah. So, and then the flipping tax. Someone else was saying they made it seem like they were going to ban flipping and make it impossible to flip. And I was worried when they announced this. I was worried, and I read through the rules, and it was basically like, but this is already the rule. All they tried to do was stop people who were flipping their they were flipping a house and they were claiming it was their principal residence to get around paying taxes on it, possibly paying 0% taxes, or they were claiming it was capital gains at half the taxable rate instead of the full taxable rate, your full marginal rate, like on a business income on a flip. So, all of us have flipped here on the panel, and we claim it as business income. So it hasn't affected us in any way. Again, like you said, perception, they just try to make it seem like it was going to do. Same thing, actually, they announced the ban on, or not a ban, a new tax on assignments, I believe, but it was actually just for new homes, new condos. So it doesn't affect resale assignments like we do. So yeah, interesting what they announce and then what the rules actually end up being are not always the same. But the most recent change that's been a hot topic that I really I like a lot is Bill 23. I don't know if you guys want to get into this a little bit about some of the changes that Bill 23 allows.
Yeah, sure. I had a guy on the show actually that wrote a part of Bill 23, and it was super interesting to talk to him, sit down for an hour. I've had him on a few times, and like being in the public realm is a very difficult position because people don't necessarily want to be in the public eye with the advent of social media. And it was very interesting to hear his perspectives on these things, where a politician 20 years ago might have been able to do certain maneuvers, either for public benefit or otherwise, and people didn't know, right? And now social media, people know, and people get concerned about this because like you're in somebody's living room or on their phone or on their tablet every single day. And if you make a good decision, they know. And if you make a bad one, now it's viral and it's everywhere. So from the policy perspective, that was really interesting to hear. On the actual Bill 23 portion itself, like, yes, this will unlock new units all across Ontario. You know what I mean? Like Bill 23 basically says people can add third units to their home in various built forms. So whether that's an actual third unit in their house, cool. Whether that's a, coach house detached dwelling in the backyard, great. So you can do it in many different built forms. I don't think many municipalities are allowing 2 units in the actual accessory dwelling itself. At least I don't know of any, but it's primarily 1 or 2 in the main dwelling, and then something subordinate either in the backyard or in addition to in the main dwelling. So yeah, 3 units, it's great. The reducing site plan control requirements as well. So anybody doing infill low rise, less than 10 units, it's easier now. So you don't have to go through site plan control. It can be controlled at the building permit stage. It doesn't necessarily, and this is again, this is kind of an optics thing. It doesn't necessarily alleviate, like this doesn't become like the Wild West where people are just gonna be like popping up houses, like all over the place. It doesn't work like that. You still have to have your surveys and your site plans and all this stuff, but it reduces some of the restriction and the bureaucracy behind how many people have to view this project before you get your approval or before you get your comments back. So that's kind of what's happening behind the scenes.
Do you guys know by any chance if you are renovating, let's say, a single family to 3 units, you're not subject to development fees based on this?
Yeah, so you still have to pay your DCs on the single, which always has been and always, at least in the short term, always will be having to pay your development charges on the single. But beyond that, how we were adding basement apartments over these last number of years with no DCs, that same thing is happening if you're adding the 3rd unit into an existing structure of some kind. So that's why people are building garages and then adding the living quarters within the garage, right? Because you're adding within an existing structure. That's why the building permit is typically a 2-part thing. The same thing went for, like, I did a property in Oshawa a few years back, and I wanted to add, this was just 2 units, but I wanted to add 2 units. And I said, okay, I'm going to apply for my building permit with the 2nd kitchen in it. And they're like, no, you can't do that, or you're going to trigger a development charge. So don't. Right? Because then you're technically a duplex, which is different than something with an accessory apartment in this particular circumstance. So I had to build the addition, close the permit, go back afterwards and put in the kitchen sink. And then they're like, cool, no DCs. That same thing is happening, barring some inconsistencies with various municipalities and so on. Generally speaking, that is the direction that municipalities are trending, is adding units within existing square footage.
Yep.
I have heard, don't quote me on this, that you may still need to pay the education portion of the DCs.
That could be, I don't know.
Even if you don't have to pay the main DCs, but it's a much smaller amount. I think they've also removed the need to pay the parkland dedication fees.
Really?
The park and lieu.
When these bills come out, they're so complicated. Like when these bills come out, they're forever complicated. And it's like, you have to be a Philadelphia lawyer to understand half the stuff, right? So like, it just takes time to work through it. For somebody asked, what is a DC? A DC is a development charge. So anytime you build a house, like for example, in Oshawa, if you've got a piece of vacant land, for you to build a single family home there costs a development charge of about $70,000. And it goes to various portions of like the school board and the region and the city. And then there's infrastructure requirements and so on top of that. But yeah, cash and lieu is a huge ticket if they've reduced that, or
someone saying they reduced it.
Yeah,
and someone just asked, what is a DC, which you said is development charge. And yeah, it basically, the city says, if you want to build a new house on this lot that there wasn't there before, usually there wasn't there before, you have to pay a development charge. And some cities are $70,000. Some are 10,000. Like it can vary drastically by municipality.
Some are none. Some of the smaller outlying communities, no DCs. Cool. But here's the thing you got to be concerned about. So just because there's no DCs, that's not a reason to build there. So many builders will go to a smaller market and build something thinking, oh, there's no DCs, right? It's easier. The lots are bigger, whatever. Cool. But like the cost of construction within a relative degree of sophistication, it's the same cost to build a house in Hamilton as it is to build a house in North Bay, right? But the value is significantly different. The cost of your land is different and the cost of all your fees are different. So really, like a DC just becomes a line item in the spreadsheet to make sure, when you're done, if you're going to make money, you're going to make money. And if you're not, then maybe you don't build there. That's why we often don't see a lot of new construction and new development in some of these outlying communities, because the math hasn't caught up yet and the density in the population hasn't either. So be super careful when you're running your numbers.
It's also why you don't see a lot of these mid-rise apartment buildings happening, because like we were assessing one in Niagara Falls to convert a single family, we go through the rezoning and then convert it to a sixplex. And in Niagara Falls in particular, Niagara Falls as the city has their own DCs, and Niagara Falls as the region has their own DCs. And when
Yeah.
you start to add it all up, we're like $180,000 just in development charge. It was like mind blowing. So it didn't make any sense. So
Yeah.
and that's
Yeah.
why things don't get built.
Someone was saying the permit process cut down significantly. So a little more detail on Bill 23. It doesn't change, like you can't just say, oh, now I'm allowed to have 3 units. I'll just go start building tomorrow. No, you still need to apply for a permit. There's still going to be often rules, and they'll be putting more rules in place about where on the lot you're allowed to build, what sizes there are. For example, I want to build one in Clarence Rockland, which is just outside of Ottawa, not technically in Ottawa. They have, in their existing bylaw, they have a rule about, because they don't have a rule for coach houses yet, or granny flats, whatever you call it, the detached dwelling units, they don't have a rule for that yet. They're relying on their other rules. So they have a detached structure thing, basically for garages, where you can't build more than 7% of the lot area in a new structure. So they're relying on whatever rules they have in their zoning bylaw to limit. So you still have to follow those, and they're going to be modifying their zoning bylaw their zoning bylaw within the next 12 months. I believe they have to. And at that point, when they're modifying it, they're going to be making rules on how to do it. So actually, it might actually allow some opportunities to build some things that they won't allow in 12 months if you get the permit now. You might actually be able to start some things in certain municipalities that haven't defined them clearly yet, because certain parts of Bill 23, they need to be implemented by municipalities over time, and certain parts are allowed right now. Again, that doesn't mean you can build right now, but that means you can apply to build right now and then build as soon as you get a permit, assuming you meet the requirements. So is the requirements on how you do a building permit going to change at all? No, but certain parts of like the site plan review, certain parts of whether you need a minor variance or to build what you want to build and things like that, those might change depending on what you want to build. You may be able to build easier, or you may not need to do a like if I wanted to build that coach house I'm talking about, I already have a duplex on the lot. It's perfect lot to add a 3rd unit in the backyard. Again, I have 2 driveways on that one. I seem to like houses with 2 driveways, and it's a big lot. If I wanted to do it right before Bill 23 passed, I'd have to apply for a zoning bylaw amendment for my lot. And with this change, I believe I should be allowed to build it now. I'll have to confirm that, but I believe I can build it now as long as I'm meeting within the other rules that they have. So I'll still have to go. I'm still going to have to get, I already have the survey done. I'm going to have to get the grading plan done of where grade is, how tall I can build, a design for frost protection, how to, a design on how I'm going to run the plumbing from the main house to the coach house. There's still all of these technical aspects. Still needs to meet building code. Still going to need probably an HRV in addition to the, whether the heat source is. So there's all of these requirements that there are going to be on it that have not changed, but it's just going to be a little bit easier, and it's going to be allowed on more lots. One of the other changes that I forgot to mention as well is the city has said the province has said you cannot require more than 1 parking spot per unit. I believe, correct me if I'm wrong there, but that's my understanding. You can't require more than 1 parking spot per unit, which means if you want to build 3 units on a lot or convert a home into 3 units total, you need to have 3 parking spots. And I believe they're allowed in tandem, but they can't require more anymore. So certain municipalities said, yeah, you're allowed 2 units or 3 units before, but you need 2 parking spots per unit. Well, that becomes really hard, or we don't allow them in tandem, etc. Or certain cities where 2 for the main house and then 1 per unit thereafter. Now they're saying no, 1 per unit total, and you're not allowed asking for more. That does allow municipalities to ask for less. They can still say, hey, you don't need any parking, or in certain zones you don't need any parking. They're not allowed to ask for more. Same thing. They also, another rule they added in there is they removed the requirement of a minimum, or they basically said cities aren't allowed to put a minimum unit size on these. So Ontario Building Code, I believe, allows you to build a minimum of 170 square feet for a unit plus the bathroom, about 10 square feet-ish. So you could probably legally build a 180 square foot bachelor. Before, cities would say, building code says that, but we don't allow anything under 70 square meters, which is about 750 square feet, because we don't want homes too small in our community or something like that. Now you'd be allowed to build a 200 square foot coach house if you wanted to. That's really pushing it. I don't recommend going that small, but you can actually get for a single person, a decent home in 300 square feet. You can really build something like that. So there's going to be opportunities to build some smaller things, take an addition on a house. You know, a house that at some point they added a large family room as an addition. You convert that addition to an SDU, to a bachelor, but you can build that for a much lower cost. It's already attached to the house. The structure's all there. It's insulated. You just have to fire rate kind of the one attached wall between that and the house, run the plumbing in, add your kitchen and bathroom. And I know that I'm making it sound easier than it is, but it's a way to keep costs way down. So yeah.
Cool
So
tip. Just on that note, Luke. So like kind of a cool tip. If you have a property, and again, just because you can doesn't mean you should. If you have a property where all 3 parking spots are in tandem, that's not really going to function, you know, arguably overly well for the tenants, depending on who's living there and depending on if there's a major transit spine in the neighborhood, or, you know, depending on the site nuances. So if you're doing that and you have maybe 2 spots side by side and one that's in tandem or some unusual parking configuration, putting a bachelor or a studio unit in typically might mean that that individual may not have a car, which means the parking issue may not actually be an issue for your particular site. So if you've got, you know, maybe you can add more square footage to a larger unit and take up some from the studio apartment to make that a bit smaller, put somebody in there without a car and give the parking spot to the people that need it. Right? That might be a good way to utilize your actual space in your land without having any parking constraints or site logistics that get in the way of a long-term rental.
Yeah. And of course, paying attention to their, you know, are you near bus routes? Is there some sort of public transportation or something? Or are you in, I don't know, are there bus routes in Kirkland Lake? I don't know, like, are you in Temiskaming Shores or something? Or, you know, are you on Manitoulin Island? That might be harder for someone to not have a car. It's pretty hard to function in some towns without a car. So making sure that you're in an area that is generally accessible for someone who might want to get around. Otherwise, yeah, if you build it, they will come. Otherwise, someone had a specific question on coach houses, or in this case, laneway construction. Do you think it's better to do a laneway house construction on my own lot rather than trying to buy another property?
Maybe not. If you can't qualify for financing and you don't have any partners that are looking to tag up with you, then doing something on your own lot might be beneficial. That could be your best opportunity to have a little bit more intensification and effectively take use of the upzoning that the province has given you for free, right? Now, conversely, if you're not necessarily a cash flow investor and you're more of an equity investor, like, because the market always goes up in real estate, right? Like if you're looking at it from that perspective, having 2 properties instead of 1 might net you more money equity-wise long-term, but your cash flow might be less, right? If you build that coach house cash, you don't have any debt against it, right? Your cash flow would be higher, but your overall ROI would be lower. So it's like, what levers and mechanisms do you want to pull and tweak in order to get the return that you want or the cash flow that you need to substantiate that build? Does that make sense? If somebody's, whoever said that, if you want to chime into the chat, I mean, respond and we can maybe help you real time.
No, I think that's a good point, that it's conditional. It depends, but we can give them the points on how to evaluate it, like you're doing, right? Yeah. Alex, do you have anything to add there?
No, I think that was perfectly said. I find a lot of people who maybe have just bought their first house, you know, typically your first house is not your forever home. So, you know, if I'm a huge proponent, because I did it myself when I bought my first property, I converted it into a rental, and then I graduated to my next property while keeping that one. So if that's kind of part of your plan and you think that a coach house would be worthwhile to be in your portfolio, it's kind of nice to see progress in your backyard. If you haven't done it before, you don't have the experience, so I can appreciate that component. But you know, as Brian was saying, it really does depend. Right?
From the educational perspective too, if you're gonna manage that yourself, what's a better way to do it than like looking, literally, as you say, looking at your window, saying, okay, this is what's happening today. You can walk out there, take your cup of coffee in the morning, do your project management, come home. Like, that's kind of fun. That has merit too. And I think the educational piece to that is something that's maybe overlooked. And if you're always just looking at the bottom line, like how much money am I going to make or lose? on this particular deal, if you go broad scope, broad picture, maybe you do the one in your backyard and you're able to get some equity back later. And then you have an income property in your yard without being in your principal dwelling. And then you take that education and you spin it out over 10 properties because you learned so much on the first one. I mean, that the ROI on that is insane.
Or if you're young and single, you move into that coach house and rent out the bigger space to a full family.
There you go.
Really capitalize on it.
Yeah.
That's a great way to do it too. I would say something to be careful of is just committing to the coach house without knowing what it's going to cost you and things like that, because construction costs are very high right now. I think something that myself, all three of us have focused on throughout our time investing is keeping a good handle on construction costs. It's very important because you can spend 100,000, maybe pushing it on the low end, building a coach house.
Come on.
You might be able 180 square feet, maybe. You know, you can spend 500,000 on a coach house, and I can't promise. I'm building 2 right now in Ottawa. I think they're both going to come out under $150,000 total, and they are 420 to 500 and something square feet. So they're small. We will see the numbers once I've totaled them up at the end of the projects. One's almost done, one's still got a lot to go. But yeah, I think they're both going to be built, each one under 150,000 each. I think they're going to be, you know, both set up as kind of junior 1 bedrooms and 1 bedrooms. So probably renting them in the, you know, it's hard to say, but 15 to 1800 range. I think at 1650 at middle mark is kind of where I'm expecting them to end up, plus hydro, which will also be the heat source. So, you know, 1650 a month on $150,000 or less build, pretty good, still pretty good numbers that would add to the cash flow for sure. Another thing about this is all pretty new, these coach houses. There's, you know, it's been going on for a few years, but not all banks are going to consider them properly in the value, consider the rental income properly in the value. Sometimes they'll take a single family home with a coach house and say, okay, it's a duplex, right? And value it like a duplex. Sometimes they'll say, no, we're only going to consider the single family home. So speaking to the lender about how they might consider something like that, if you're going to be relying on refinancing them. For me, if I have the capital to do it myself, I might refinance a different property that I don't need to leave the equity in, let's say, take that out, and then do a coach house without refinancing it at the end of the coach house. And then that'll just kind of help my cash flow. So I might be able to move it around between properties, but if you're relying on refinancing out of that coach house, speak to your lender before you go ahead and build it, because you may not get what you want out of it, or it might do really well. And it's hard to tell how appraisers are going to treat it. Two units in a house plus a coach house, are they going to compare it to the triplex down the street? Is it going to be, well, we have no comparables for it? It's going to be a tough one. So valuing it's going to be interesting there.
It's probably a couple of years of that. Like eventually the market will catch up. These things will transact.
Yes.
You know what I mean? If you're doing enough of them, you could make your own comps. So go do volume, folks. Go do volume.
Yeah.
Like in time, the market will catch up. I think it's the same thing when the whole legal basement apartment thing came through. People are like, legal, non-legal, does it really make a difference? And like, you know, it does. A legal unit's worth more, truthfully, than a non-legal unit.
Yeah, absolutely. Yeah, and I agree. Where it's possible to build legal units, try to always build legal units. I agree with that 100%. And I know some people don't always follow that when they're starting out. Sometimes capital requirements and things like that. But I find over time you sleep better at night knowing your units are legal, and you have more protection from insurance and liability that way. Someone had some questions about, well, there was a few questions about kind of incorporating. Someone was asking, what are the benefits to incorporating? So I don't know if you guys want to shoot off. We can talk about some pros and cons of incorporating. I'll start off with the con. Some lenders don't touch them. Some lenders make it harder to borrow against them. For example, several of the A lenders, I believe Scotiabank is one of them, you can finance a rental held in like a single family home. We're talking single family specifically. Multifamily is different. Single family specifically, some A lenders will only actually do it when you go direct to them. So you have to go to a Scotiabank person to get a Scotiabank rental property mortgage if it's held in a corporation, whereas you can go through a broker who can get you more options if it's held personally. So there's different options
BC, I
that
think
way.
did the same way. We did it for
Yeah.
BC this
And
year, so.
often some lenders will have different, well, they often do have different prices if it's held in a corporation or not. So you might end up paying 0.5% higher in interest rates, or sometimes up to 1% higher. So you might end up paying more, right? So that's kind of some of the negatives in incorporating. You guys want to?
I think that there's an important point with regards to incorporations, that if incorporating, is holding you back from taking action, probably don't think of it that way. You should just do something, whether you're in your personal name or in a corporation. I think that for me, there's tax benefits obviously within a corporation. However, starting a corporation, corporate filings, that kind of stuff does become a lot more expensive than if you're doing things in your personal name. So for us, it just helps us segregate our assets. It's we have strategies that we work on in terms of like tiered corporate structures and things like that, because we have active businesses and passive businesses. So once you start getting into that, it makes a lot more sense. However, if you're brand new and you're deliberating, should I incorporate or not? Probably not the best thing. Just to start getting some experience is probably way more important, I would think. So.
Yeah,
I'd agree with Alex on that. I mean, you can get so in the weeds with should I incorporate, should I not incorporate? Personally, like I did my first few deals not incorporated, right? I just did it personally. And if you make a gain, you pay the tax. And if you make a loss, you get a credit. You know what I mean? Like that's just kind of how it rolls. And if you want to get more complicated and go and do more deals at that point, great. I know a few people who have a ton of properties, like an ungodly amount of properties in their personal name, and they haven't incorporated. That's their choice. Like in some cases, it's not tax efficient to incorporate, right? Because of the structure that you're set up as. And in some cases it is. So like totally case by case. I'm not an accountant. I am incorporated. I do have some corps of varying degrees for various properties, for primarily for like asset protection and liability and things like this. But like that doesn't negate the need to be insured or the need to do a good job or anything like this. I mean, you still have to do these things. I think really it just more comes down to asset protection and liability. At the end of the day, talk to your accountant.
Yeah, and I think I was going to say, I think there's sometimes more talk about liability protection under corporation than there is. There is liability protection by holding property under corporation. Technically, you know, unless there's negligence on your part that might allow someone to pierce the corporate veil, you're typically limited on how much you've invested in the property in the corporation. However, a lot of people seem to forget you're personally guaranteeing the mortgages for most part. So
you're not
your liability is going to be on the entire, you know, the loan amount and right. So get good insurance. Make sure.
I heard there's a lot more important in the States. Like we just incorporate actually in the States because we're going to be buying some properties out there, and we're working with an asset defense team, and they're like, oh yeah, we sue each other all the time here. This is what we do, and that, you know, that's very important if you're in a market like in the States. It's a lot harder to pierce the corporate veil depending on where you've incorporated and what state, depending on their laws and how you go about doing things. So it's but as you guys said, and here in Canada, it doesn't really matter. You're right, you're personally guaranteeing most of the stuff anyway.
Yeah, if you're personally guaranteeing, you still have more protection, but it's not as amazing as sometimes people make it out to be, but it is still more protection holding a corporation. So yes, if you hold it in a corporation, technically someone shouldn't be, you know, when someone slips and falls or something like that, and they try to sue you, they're not suing you, they're suing your corporation, right? But again, in either case, it should be your insurance company stepping in at that point, because you should have good insurance on that. And it's not like you can just walk away and then, you know, they take the house or something, because the lender's gonna want to be made whole too. So then you're covering, you know, that part. So yeah, not as good of liability protection as people think, but it's more than not having it for sure. And yeah, and keeping liability separate into corporations is a good thing as well when you do things separately like that. Yeah, and someone asked, are you referring to a holdco or opco for incorporation? It can be either. You don't have to overly complicate it. I personally have some stuff held in corporations under a holdco, but I also have stuff held completely separate in other corporations that aren't under the holdco. So it gets very complicated, and there's pros and cons to almost everything you do that sometimes make things worthwhile, not worthwhile, extra tax amounts, there's some extra cost. So, but I do agree with you guys when you were saying, it's very common people start off, they buy the first couple properties personally. And then if they see, you know what, I actually am going to be doing a lot more of this, then at that point, it might be worth starting to start buying through corporations. And one other benefit of buying through corporations is what I see is it limits you less on your ability to buy your own primary residence. Because sometimes you buy a bunch of rentals held personally, and then you go try to buy your own house to live in. And it can limit your ability to borrow on those mortgages, or banks have limits on number of properties and things like that. Even if it's your primary, they may still not lend to you. So it can get harder to buy your own house if you own too many rentals personally when you're trying to move and buy your own house. So can be a good reason to hold in a corporation there as well. Yeah. All right. What else? Someone else was asking, what's the capital gains tax rate for corporations?
No idea. Not an accountant. Don't know.
Not
Not
if I were
sure.
to guess, like, I don't know either. This is literally a guess. Is it like 15%, something like that? Is that, yeah?
I think typically the capital gains rate is half of your regular tax rate.
Like, I know for personal, it's like 25% of that, right? It's 50% of the gain.
Yeah, 50%. So yeah, if you're taxed normally at 40% personally and
Right.
you have a capital gain, well, they only add half of it and they tax half of it at 40%. So really it's like they tax 20% on the gain. I think same thing, the corporation depends on your corporate tax rate, which is going to vary because there's actually a different tax rate for passive corporations versus active corporations versus CCPCs, Canadian controlled private corporations, which get the first $500,000 of net profit at a preferred tax rate, except for, well, and then a different dividend rate that's actually higher that nets it out once you take it out. So if you leave it in the business, you end up holding money. So it's complicated. I would talk to an accountant about it. It's kind of point of what I'm trying to get to. But yeah, for active businesses, it can be helpful to, if you're leaving the money in the business and reinvesting, you actually end up with a lower first tier tax rate, so to speak, in the corporate, under a corporation. And so that can make it worthwhile if you're reinvesting your earnings, you get to keep a little more of it to reinvest. But I find if you're taking all of it out of the corporation every year anyways and dividending it out to yourself, your net effect on taxes is about the same as if you were holding it personally. So there's not much of a tax benefit there. It's really only if you leave it in.
If you're paying capital gains tax, then just know that you made money. And that's, if you're a new investor, then that's probably a good thing, good place to be. So
yes. So someone asked, and I think this would be a good one. What's a good strategy for a new investor to start off with?
house hack for sure, man. For sure.
Sorry?
House hacking. I think it's personally because I did it twice over again. So I find that a lot of people, especially us youngins, we want to buy a house immediately, same type of house that our parents have lived in now for the last 20 years, and we have these expectations of what our house should be. People
Can you explain house hacking?
Yeah, well, house hacking is effectively that you're renting out your house while you're living in it. So you're effectively hacking that house and you're using it to its highest and best potential to gain income while you're living in it. And I do think that a lot of people think that they can just get to that dream home right away. Whereas most people, they say that the average Canadian will move 7 times in their life, which is pretty wild when you think of it statistically. However, a lot of people right out of the gate are like, no, this is my dream house and this is what I want. And they don't realize that sometimes if you just sacrifice 1 year, you can get there a lot faster and with a lot less financial hardship. And by doing that, like, for example, my first property I had bought, I rented out the rooms. I was a single guy at the time. I didn't necessarily need to have a whole house to myself. And renting out 3 other rooms, I was living in the house and I was making like $600 a month cash flow while living in my own house. It was crazy.
That's
So
awesome.
And the same thing, that house hack can be, Airbnb-ing your coach house if it's allowed, right? Build a coach house in the back, Airbnb it. Live in the coach house, rent out the main house. Rent out by the room in the main house, but you live in the coach house, you have your own unit. You can have an in-law suite. This might be an easier situation to live in a non-legal duplex, with it possibly not entirely being illegal. because if you live there, it's a little more lax, the rules essentially. So, you know, with an in-law suite, but it's not, it wasn't built as a, you know, purpose built, or it wasn't legally retrofitted as a duplex, but you could potentially live in your own suite while renting out the rooms upstairs. And so technically it's shared, it doesn't meet the same criteria, and you're not really breaching the rules of it not being a legal duplex, so to speak. So yeah, you could potentially live in the SDU and rent a main house, or vice versa, while you're living there. So yeah, or duplex, triplex, fourplex, whatever. Rent out, you know, live in one of the units and rent out the other ones, and find a way to that can just, because one of your biggest expenses in life is housing. And if you can cut that cost down, it's going to allow your savings to go up drastically, which will allow you to scale. Buy more properties gives you, when your savings are higher as well, it gives you a much safer place to invest from. You know, you have a really high savings rate, and then you're on a variable rate mortgage, and interest rates go up. Well, you had a really high savings rate, so you're fine, right? So yeah, that's a good thing. I think just in general, I would also say I think rentals in general are a really good place to start. Even a more affordable rental. I think you just learn so much from that first rental property. I started with my first rental property at Jane and Finch in Toronto, rented it by the room, made a ton of mistakes, was way too nice. I was way too nice to people. And I just learned a ton from that. So I did renovations on it. I actually, you know, hired a contractor and then worked with him alongside him, so I could learn what he was doing and be able to do renovations myself and things like that. So I learned a ton off my first rental property, and rental properties with time are very forgiving. Real estate in general with time is forgiving. You just have to be able to withstand the low points. But so I find a rental property is more forgiving of mistakes. You go over budget on a long-term rental, you're probably not going to lose money like a flip. You just hold it longer. Whereas on a flip, you have to sell. You might lose a bunch of money. So someone's asking if you risk the principal residence exemption when you're house hacking. Ask your accountant. I think if you're actually renting less than 50% of the space, you don't lose it. I believe you can also prorate the amount that you get. This is, again, this is a limited overview. You should talk to a specialist on it if that's what you're going to do. Someone also asked about roommates. That can actually be an advantage, because Alex, if you had a roommate who was unruly and didn't pay you, yeah, you can pretty much, I mean, I think you're supposed to try to give them 30 days notice, but it's not a hard and fast rule. You know, if you have someone who's causing problems in your house and they share either a kitchen or a bathroom or both, they're not subject to the they're not subject to most of the rules in the Residential Tenancies Act. They're still subject to certain rules for rent increases, but they're not subject to rules about security of tenancy, essentially. So you can say, hey, you know what? My girlfriend's moving in. I want you to move out. Bye. You don't even, what I mean is you're not reliant on giving them, in that case, an N12 and waiting for a hearing at the landlord-tenant board that's going to take forever. You just say, hey, I need you to leave at the end of the month, and you're legally allowed to do that. So that's a huge advantage to house hacking as well. And another kind of a bit of a forgiving safety net when you're starting off as a landlord. You might be a little too nice. You hear the sob story, you're like, sure, I'll let you move in. And then they make your life terrible and you kick them out quickly, instead of having to go through the landlord-tenant board on your, you know, on your first property. That would be an easier way to learn that if you're sharing part of the house with them.
I definitely don't underplay what you had said earlier about the about learning while you're living there, like especially with renovations and things like that. It is, and well, not just renovations, property management in itself too, like setting expectations, like, you know, not being afraid to ask people for money when they're late for it. You know, these are very important things, especially if you're hoping to become successful at real estate investing. You have to start to know that, like, I remember when I bought my first place, I decided to do the wiring in the basement. And I actually went through permits and I had 47 deficiencies on my ESA list. But, you know, I slowly worked with the inspector, was awesome, and actually sat and like taught me electrical, and I got through it. And now it's like, now I can confidently talk with electricians on my job sites, no problem. So it adds this tremendous amount of value if you're just learning. It's like you're learning on the job, but at home, right?
Yeah. And you don't have to know how to do all the work necessarily, but it helps to be able to talk the talk and be able to understand what someone's telling you that they need to do, make sure it makes sense. It makes a big difference. So a question we had is a couple about financing. One of them is, how do I get financial partners when I'm just starting out?
Track record obviously is key. Like people say, well, what have you done in the past? And vis-a-vis, by telling them what you've done in the past, that's going to solidify how good or otherwise you may or may not be, right? So when you're first starting out, I mean, I think getting some education would be really important. Like just being on this webinar, you're picking up on so many things. So if you can show somebody, maybe it's like a friend or a family member or a friend of a friend or a friend of a family member, like somebody that's kind of in your inner circle where they can buy into your story. I think that's going to be way better if you're honest with them and you say, look, this is what I want to do. This is my clear plan to do it. I know 2 or 3 people in the industry that have done it before. I'm going to mimic what they're doing. And I'm also spending some time to, learn all the free stuff on YouTube and buy all the books and like take on a partner who's already in the industry, who's not in it for the money, but they just want to see me succeed. Like do all of the things that you can do either for free or for very low cost. And then you can explain that story to somebody as to why you're going to be successful, right? If you can get them to buy into you, which is number one, like you always invest in the person first, because like a good investor will turn around a bad deal and a bad investor will destroy a good deal, no matter how good it is, right? They're investing in you first. So you got to be able to sell your story. And I think from your story, that's how you'll get the money. Don't go for the money, go for the story.
That's good. To add to that too, if you're really not sure about how to approach people, what you can do is, well, that's probably not the right way to do. You need to approach people regardless, but find the opportunity. I think a lot of I know myself, if some person came to me and said, Alex, I have a dynamite deal. I bought this thing for 50% of what the fair market value is. I don't have any capital. I don't have anything, but I want to be a part of it. Like I wouldn't have an issue cutting that person in, and I would then go find the money from my resources because I have the capacity to bring joint ventures on or whatever. In fact, that actually recently happened with a guy who I've been dealing with. He's looking to get into the real estate and he found an opportunity. And now we're looking to add him in as even like a 10% partner. Even though he's not really doing much legwork, all he wanted out of it was learning the process of how to do it. And then once you do it, that's like a stamp on his resume that I did it and I am owner of this property, because he is now part owner of that property. And now you've got some cred. And so I think that a lot of people discount the fact that so often I see in like these Facebook chats, people throw these like not deal properties out and they're asking the masses for money. And to Ryan's point, where people will invest in you, but if you have some sort of backing, it makes it a lot easier to do so. And that's the challenging part with a lot of people who are looking to get into the trade or the business, I guess. So if you can go out there and hustle, and I'm talking like go knock on a door. You're driving down the street and you see curled up shingles and the grass is 3 feet tall. Stop your car, go knock on the door and say, have you ever thought about selling? And if they tell you to piss off, then that's one in the bank. And then you go to the next one.
They're going to say, Bliss Realty just purchased our home. I'm sorry, you're too late.
Yeah, exactly. You're a little too late. Exactly.
Hopefully.
But people laugh, like they're like, oh, that's such bullshit. Like my principal residence where I live was a cold call and nobody believes it. But it happens all the time. Like I sometimes carry just like little business cards in my car and I pull over all the time and knock on the door. And I've literally probably had a dozen leads from just knocking on someone's door. And then maybe it's not right away, but they go in my database and I follow up in 6 months and then they're ready to sell and we make something happen.
Yeah. There's a lot of meetup groups too that you can go to for like really minimal cost. You know what I mean? Like $0 to $100 a month. And you can go to meetup groups all over Ontario, no matter what region you invest in, even if you're not in Ontario on this call, if you're in BC or Montreal or wherever, like people are just willing to share and help you be better. And once you are better and you tag along, like you're going to win. People are going to see you at those meetups. They're going, oh, that guy that goes to every single meetup on a Tuesday night And I've seen that person, I've seen that girl for years now. I wonder if they've done anything. They seem really persistent, right? They seem really genuine, right? You shake hands and you say hello to people. Eventually something will crack. It's a numbers game. So you have to go talk to people, be genuine, get out there.
Yeah. I think often your first investors are going to be friends or family, right?
Yeah.
People who already know you, and they trust and they know who you are as a person. They know, and so if you can prove, if you've ever heard the saying, what's the saying? How you do one thing is how you do everything, right? So if someone sees that you go all in, your moral compass is right, aligns with theirs, you do the right thing, you work hard, and you've shown that in the past, and now you're starting in real estate, they're going to believe that you're going to do that in real estate too. So someone who knows you already, that's one. And then as Alex said, even if you're taking 10% of a deal, don't be afraid to bring a deal to someone who's an investor who has more money than time. And you say, I will put the time into this. I want to get this onto my resume. I will put the work in, and I only want 10% of it. Barely going to pay for my time, this 10%. But I want to put this on my resume. I want to put this on my track record. I want to get the experience of it. I understand I might make a few mistakes that will cost you a bit more money. I'm doing everything I can to learn to avoid that. But because of that, I'm going to take way less ownership of it. So you're going to net more in the end anyways. And so if you can convince someone of that, and that what you've learned, and you have a good chance of having a high success, you have a better chance of convincing someone to do that. So yeah, I think that's a good way to do that. Someone asked, Alex, do you keep your realtor license?
Yep. I hope so. I just sold Luke's yesterday.
Property yesterday.
No, I do. And I do want to preface, it's not necessary as an investor. In fact, I do 2% agency stuff in my world and 98% investing stuff. The only downside I will say is that I always have to disclose I'm a real estate agent. So unlike Luke, who goes and buys a property and he can like ninja his way in there and ninja his way out, I'm always like, I work for such and such, and this is how I do it. And you have to sign on the dotted line saying that I told you to do it. And even in my like Schedule A, I usually say like this client has had the opportunity to contact a lawyer because like God forbid these guys go to RICO, and then I've got, So there are some downsides actually with having a real estate license. People think it's like super sexy to be able to search comps, but it's the smallest part of the job, totally. So yeah. But just to preface, it's not required. I do think that when you're in real estate, it's a good way to learn sales, which is what I intended to do. That's why I got into it.
Yeah. I'm going to hit some of the questions people are asking. There's a specific one for you, Alex. How did you make the transition from engineering to flipping specifically? I'm also an engineer and passionate about real estate, specifically renovations, property development, and I don't know where to start in terms of learning about renos and development.
Honestly, house hacking. I was working at Acon, was making a really comfortable salary with all the benefits you could ask for. And the company treated me really well. Actually, I loved working there. And a couple of them are my joint venture partners, funny enough, from Acon. But
because of how you do one thing is how you do everything. And they know how you were. They know who the person you were when you were at Acon. And
yeah,
take that to real estate and you're going to do well.
So in the pooch there probably wouldn't work very well. But my transition was through I house hacked my first property. Then I did another one where I actually moved closer to Cambridge. I was about in Kitchener, and I house hacked that as well. I legally duplexed it, so I was learning the process. I was doing it. Then I did my first flip, which was like a complete disaster. And well, we made like $256 after like a full summer of us doing all the work ourselves. But that was my school of flip. And in my second flip, I made more than a year's salary at Acon. And so it wasn't enough. That's not enough of a cushion for me just to have a year's salary. I needed consistency. And so I thought, what better way to get to the face of real estate than to get my realtor's license? And so then I could learn to become proficient at selling. Because as engineers, often we are kind of in our box, and some of us may not be comfortable going and approaching people or cold calling or getting shut down multiple times. But unfortunately, in this business, it is a business of no's, and you work those no's to get to your yes. And so I've had a lot of rejection, and because of that, Well, case in point, you look at my wife, she's a rocket. A lot of rejection up until then, though. So same kind of thing, but you just start sequentially and you work your way up. But you don't have to go that route, as I said, with the real estate license. Like a good buddy of mine who I know is on this, his name is Russell. He's an engineer too, and maybe you guys could connect. He's been buying properties and assuming or accumulating a portfolio in such a way that now he's getting recognized by others, and opportunities are starting to come back to him. And then all of a sudden, you can step out. You're welcome for the shout out, Russell.
And I will agree with Alex that his wife is better than him in every way.
Your eyes on your monitor there, Luke.
All right, so another question was, how do you get perceived past the stuck point when it comes to financing? Since we're on the financing topic a bit, banks will only give so many mortgages based on personal income. I assume it's to buy buildings with more doors, 6+. The mortgage is based on cash flow, not personal cash flow, and or JV with others. Would love to hear a bit more about some strategies that worked for others. Thanks. So again, how do you get past that perceived stuck point with financing? Yeah. When you're kind of capped with your income. When you're no longer qualifying because you own so many rentals.
I would say if
What?
You wanna go?
No, you
I would say at some point, if the bank is cutting you off after 5 or so, yeah, you got to go to multifamily. Like how many duplexes do you want to own? You're kind of majoring in the minors at that point. So you have to say to yourself, okay, if I want 100 duplexes, can I not just go and buy 1 or 2 apartment buildings or 3 apartment buildings or something like that, where the property will substantiate the cash flow, which will then debt cover, to some degree. And then if the numbers make sense, you buy that thing, right? Because like at some point, I was in this problem where I had so many duplexes and all these infill builds and like all this stuff on the go. And like just, fortunately I had full-time staff, like T4 guys, where they could go to the properties, maintain it and all this stuff. But like, if you're in multiple markets, you've got a duplex in Nova Scotia and you got a single family home in Calgary, and then you got something in Vancouver, like you need to combine forces so that you're more of a bigger fish. A property manager, when you're small, like they might take on your property, but if you're too small, you won't get the focus that it deserves, right? So once you've hit that financing ceiling, either you have to take on partners, or you go to B lenders, or you go to bigger buildings that carry themselves, or you change and you go to commercial, or you go to storage, or you go, some other form of investing. Maybe you start flipping. Maybe you don't do any more rentals. Maybe you flip, right? So like, there's lots of other ways that you can continue your journey in real estate. But in terms of like residential real estate, renting properties, monthly tenants, things like this, you have to go bigger, or you have to take on partners.
I love that line, majoring in the minors. It's good. Let's keep that.
Yeah. Go bigger, take on partners. There is still some tricks, like working with a really good mortgage broker, possibly with being incorporated. There's some ways that can help get a few more properties, but you're always going to end up getting capped. And eventually also they're going to be getting more expensive too. Like might be going to more alternative lenders. You can start off with all A lenders, that's great. And then you start getting into some B lenders. And then when you have more with certain B lenders, they start charging you higher rates and it just gets more and more expensive. So yeah, moving a bigger product or partnering with others who are able to go on title to get the loans is a good way to keep scaling those if that's what you want to do.
Yeah. Hey, one other tip on that is, if you are married, like you and your spouse, if you can go on 4 properties and your spouse can go on 4 properties, that might give you an option to get 8 properties. Like if that's your goal, just know that at some point, whether it's partners or spouses, or you tag up with a family member or something, just know that at some point you're going to come to that same situation again. And if you're looking to go beyond, like, and continue, not hit that glass ceiling, not hit that problem, just a few steps down the road, you have to go to something bigger where the cash flows support the property. You have to do that.
I will say we've all learned a bunch from our mistakes. One of my mistakes early on, 2012 maybe, I bought a property with 2 partners. All 3 of us went on title. Supposed to be a BRRRR. This was in Aurelia. So prices back then, it was I paid $219,000 for a bungalow. I spent $55,000 turning it into a legal duplex, winding the driveway.
That's so cheap.
Yeah, so cheap. They're $150,000 to $200,000 now. A lot of legal duplexes, sometimes more. So those were the numbers back then. It was $275,000 all into a legal duplex. Now all 3 of us were on title. And because of that, all three of us were on the mortgage. And when I went to go finance a different property, they took the full amount of the mortgage against my income, and they took a third of the rental income to add back to my income, because I only owned a third of the property. So I was somehow responsible for 100% of the debt, but I could only get a third of the income from it. So as Ryan was saying, if you can avoid it, I know some people emotionally it can be strange. I would avoid being on title of your primary residence with your spouse. Pick one or the other. You don't both need to be on title of it unless that's the only way you guys can qualify for the loan. You don't both need to be on title on it, because one person buys your expensive home that you live in, they might not be able to qualify for another rental property, but now the other spouse doesn't have a mortgage under their name. They can now go qualify for the rental property. So that can be another way to scale, or to just keep buying more.
There's an interesting part. There's a book out there called The Millionaire Real Estate Investor, and it says that every investor comes to this moment where they either have to stick or switch. And what they mean is you either have to stick with the way that you've been doing it, but you got to expect different results, or you switch your strategy and you start to learn something else. And to these guys' points, when you get to that certain level, you have to choose to either stick or switch. And when you're sticking with it, expecting those different results are bringing on joint venture partners, or taking a cut on, your work may not go as far because now you're having to bring in financial partners or have someone else to qualify for you. But unfortunately, these things happen, and it's actually how you move and flow with the work at hand, right?
I'm going to try to get out of we still have probably another 100 questions in the Q&A from people who signed up, but I'm going to try to move to the questions that we have in the Q&A box for the people who are here today. Before we do that, I wanted to answer a couple questions that we had about this company, Bliss. Some people or just in general, some questions, like somebody asked, does your company offer a referral program? Absolutely. We'll usually, there's different percentages depending on what you're bringing, but if you're bringing a good lead, we'll partner with you on it in some way. Typically, if somebody's bringing a signed contract, but they're not sure what to do with it, and they want to work with us to selling it to our list, so we'll joint venture on that, and usually that's a 50-50 split, where we'll partner with you to sell that, and then our concierge team, and we call them our closing concierge, they will handhold the sellers and the buyers to get it through to closing to increase the odds that it actually closes. So we do, and if you're just sending us leads for sellers, we're happy to work with those as well. So yes, referrals we work with. Someone else asked, this is not really about us necessarily, but about co-wholesaling. How do you frame the terms? I guess I'm just answering that because it's related. Co-wholesaling can mean a whole lot of different things. It might mean someone brings the lead. It might mean someone else is selling it. It could mean so many different things. It could mean someone's bringing a signed contract. So the terms are going to depend on what it is. Something that's important to note for wholesaling is in order to not, like Alex said, he is a licensed realtor. I am not. In order to not be breaking any REBA rules on brokering without a license, I never represent anybody else. Our company never represents either the seller or the buyer in the deal. We are only acting in our own interests, which means we buy a contract and then we sell a contract. Sometimes we buy into a contract via joint venture partnership, and therefore we're now representing ourselves again in that as part of the joint venture. So we're never acting for somebody else. We can't sell a deal for someone else. We can partner with them to sell the deal. So I just want to make that clear. If you try to wholesale a property, don't go trying to represent the seller to the buyer or vice versa. You're representing yourself to both parties, and that way they know you're not a fiduciary to them and you're not breaking any rules. One thing I want to say, I think most people have signed up. You guys are probably already on our buyers list. So if you're take a look at our deals, I think there's great opportunities right now to buy off-market properties. Something else, if I can ask you guys, I'm going to be upping my the next few weeks. I'm actually going to be changing my handles on social media and upping my social media presence, trying to put a lot more content out there. So I'd appreciate if you guys could follow me on my current handle on Instagram, and you guys will start seeing a lot more real estate content there. It's at French Luc. I'm just going to type it into the box right now. So if you could follow me.
For anybody on the call that hasn't actually bought anything from Bliss, the process is silky smooth. it's if not the best, one of the best that I've ever experienced in terms of buying wholesale deals. Like their concierge team is legitimately a concierge team. Like if they could be wearing white gloves on the other end of the phone, I think they would be. And you know what, Luke? I think they should.
They might be on their
Next
phone.
time I call, I expect somebody to be wearing full white gloves. Kat, get some white gloves. I'm calling you.
And on the disposition side, we joint ventured. We haven't bought, but on the disposition, you should get them some white gloves too, like the little dream.
Same, yeah.
Yeah,
So nice. Like we get a good opportunity. Like I can't deal with this, but why don't I just call Luke quickly? And it's like, yeah, we'll take care of it. Like one of them, I think we made like that Burlington one. I don't know how much we made. It was like 70K or something like that on it. I literally didn't have to do anything after just getting it under contract. It's wicked.
So yeah, and I'd love to take credit for that, but as they mentioned, Kat and the rest of our team, Kelly, Katie, Rebecca on the transactions team, and just the rest. We have a very good team in our company that handles all of it. So if you're out in BC, you'll be talking to Tammy. So yeah, we have a really good team. So I can't really take credit. They're all nicer than I am and better at their job than I am. So that's the good thing. That's the good thing. If you ever wonder what the secret is to scaling up and growing a business, it's hiring people who are better at their jobs than you are. That's the secret. Okay, so before we get back to some of these questions, I want to ask Alex, is there something that you're looking for from our audience here? Is there anything that they can help you with? Are you still taking investor partners on properties sometimes?
Yeah, for sure. We're still doing joint venture consults. We are in a process where we're exploring kind of new territory right now, which is really exciting. We're going to be looking to invest in the US. And part of that is because we've had a lot of joint ventures that have reached out who are like, listen, I got like 50, 60K. What can I do with that? And in Ontario, not a whole lot. That'll buy you like a couple kitchens maybe and some appliances. But I think that there is, once again, a really great opportunity out there, and I'm super excited for it. So that's a big thing. And another one is that you guys do have rental properties in and around the, Hamilton, Brantford, Burlington, Welland, St. Catharines, Niagara Falls areas, and you need help with property management. We actually have a really great property management team. So I'd love to help you guys out.
Awesome. Alex, where can you drop in the chat where people can contact you and
get
in touch with you? Same thing, Ryan. I know you posted earlier if you want to repost about your book. If you guys haven't heard, Ryan's got an awesome podcast out there, the Highest and Best Use podcast, as you can see in his background. And he's got his Highest and Best Use playbook right there coming out. What else do you want to tell us, Ryan?
That's pretty much it. I would love for people to chime into the podcast and give me some feedback. I'm always looking to improve and get better. There's about 17 episodes that have been released so far. We've got about 40 or 50 in the pipeline. We're booked like way deep into 2023. So looking forward to getting more episodes out. And yeah, sign up to the book if you're into land development, creative renovations, loss avoidance, things like that. You might get some value from that.
Yeah, I'm excited to read it.
Did I give you a book when you were here? Luke was on the
No.
podcast. His episode's coming out in like a month. Did I give you a book when you were here or no?
No, you didn't, but you had the hardcover, kind of your sample out there to look at. So yeah, it was pretty cool. All right, back to some of these questions. Let's go. Actually, I'll take this on now. What's the best way for a beginner with no properties to engage or work with a wholesaler? To be fair, I'm not exactly sure what they mean here. Do they mean buying from a wholesaler? That's harder to do for your first deal. Definitely start communication well before you see a property you like to try to understand how you might finance it, possibly get vetted by a private lender, that kind of thing. Otherwise, if you want to work with a wholesaler, start looking for leads. There's a lot of information about there on YouTube and stuff like that. If you come, like Alex was saying, go door knock. If you come to us with a good lead, we'll be happy to work with you on it. You'd be surprised the number of people who reach out to us that haven't done anything and want us to do everything for them or explain everything on how to start. And we typically are going to be way more motivated to help someone or work with someone who's shown initiative of their own. So if you go out there, you ask for leads, even if the leads don't turn out to be good, if you come to us, someone on our team will try to help you understand why it might not be good or why it is good. And then we'll see if we can work together on it. And that way it's a bit of education, what to look for the next one, and you can keep going. So yeah.
Bird dogging's a super awesome way to get into real estate. So good. No risk, right? You're using your time, not a lot of your own money. Send the deals to Luke. and he'll take it down. It's brilliant.
I realize it's 5 minutes to 8. I still want to go through some of these questions from today, so we'll probably wrap up in about 15 minutes. So probably just after 8 o'clock there. So one of the questions here is from Remy. When you flip, do you make sure you renovate less than 90% of the house to avoid the HST?
Yes.
Simple. For those who don't understand the rule, do you want to explain a little bit?
Yeah, so anything 90% or more is considered a substantial renovation, and a substantial renovation triggers HST. HST is 13%, obviously, on the value, the newly constructed value of this home. And the challenge with this is that there is no input tax credit other than the cost of your renovation to offset that HST. So without going too far into the weeds, because I'm not an accountant, right? HST on $1 million is 130 grand. If you spend 100 grand on your renovation, which is too light for a substantial renovation. But anyways, if you spend 100 grand, that's a $13,000 HST input tax credit. 130 grand minus 13 grand means you have to pay an additional 117,000 bucks for the house that you already own because there was no HST paid when you bought it, right? Resale residential has no HST component unless it's an Airbnb, and that's a whole other thing. So what the root of the question is yes, renovate 89% or less, or I believe there is a way that you can renovate the other 10% over a really long period of time and not trigger that. So if you go to the CRA website, they actually have some really good case studies that you can read on how it works and how you can make it work for you and still play within the confines of the rules. But yeah, 89% or less. And there's a different way that they calculate it depending on your circumstance. So
and the language there is substantial renovation. So it's similar, HST is subject to new builds or substantial renovation.
Yes.
And the wording they use is, I believe the wording it's used is removing or replacing 90% of the interior of the home.
Yes.
So you might be able to, how you calculate that 90%. For example, if you have a 2-story home and you got everything except the basement to the studs, all new electrical, all new plumbing, all new insulation, everything, but the basement was finished and you leave it finished as is, and all you do is paint it. Painting typically doesn't count. Again, talk to a specialist, but that would only be 66% of the home renovated. Even though everything above grade is 100% renovated, that's not 90%, that's 66%, 67%, whatever, because you left the basement as it was. So yeah, just consider, you might be able to get away leaving 2 rooms unrenovated and it's still, and all you do is paint them and the entire rest of the house is gutted to the studs, and that might not be a substantial renovation. It might be worth looking into that if you're ever pursuing that larger renovation, because the HST implications suck. So plan around it, and if you're doing that, document it. Show the entire house gutted and those rooms not touched, and keep photographs of the progress of those rooms not being, only being painted, for example. So because if they ever come back and say, oh, it looks like this was wholly renovated. No, the entire basement wasn't. Here's pictures, here's proof. Here's timestamp pictures, whatever it is. Because you don't want to accidentally be forced to, well, not accidentally, but be forced to pay HST because you can't prove something as well. So document it as well, and don't do it. Okay, another question we have is, same person asked, where do you recommend us looking for good deals other than through Bliss?
Driving for dollars, cold calling.
Yeah. I'm actually seeing opportunity on the MLS. I just bought one off the MLS recently. I'd been sitting, kind of took a 2-stage negotiation to get it down, but there's some opportunity on the MLS right now for things that are priced poorly, but the seller actually has motivation. There's some ways, not easy, but there's more opportunity than there was a year ago for sure.
What's really interesting when the market changes is that all the strategies change too. So just like Facebook and Instagram, they adjust their algorithm every so often to make sure that the big dogs aren't always the big dogs, that it does make room for new players in the game. Wholesaling is very much the same way. So like if yellow letters are working today and bandit signs are working tomorrow and cold calls are working the next day, and then the strategy pivots, not everybody pivots on the exact same moment, right? Which leaves gaps. It's like merging into traffic. You pull on the highway and sometimes you have to speed up, sometimes you have to slow down, but eventually you make your way in the lane, right? That same thing goes for wholesaling. So like if you just Google 10 strategies for wholesaling, how to find deals, bandit signs, yellow letters, driving for dollars, cold calls, talking to realtors, expired listings, like all of these things, getting on every wholesaler list that's out there, talking to Luke, like staying top of mind on the Bliss list. That's great. People know you're serious. They know that you can close cash or cash equivalent. They know that you're legit. You have strict buying criteria as to what you're after. And because you have that buying criteria, that's how you know what deals you're looking for, and you'll know when you found it. Because like, if you don't have buying criteria, you won't know what a deal is, even if it lands in your lap. It just won't make sense, right? You can't compute that. So being prepared and then doing all those things I just mentioned would be a really good way to break into that.
Nice. All right, someone, Gurpreet Bobby Singh, he asked, are power of sale properties good to look for? And I'll answer this a bit. You're often in the States about foreclosure deals, and there's great, deals on foreclosures. We don't try not to nerd out on this too much. I took a class on this in law school, but basically, power of sale in Ontario means the bank takes control of the property, they sell it, and then if there's more money left over than what the mortgage was owed, they will give you the difference, minus the legal costs and all of that. If there's less money owed, they can still come after you and sue you for the difference. Whereas in foreclosure, which exists in Canada, but doesn't happen 95% of the time, foreclosure exists in Canada. The difference is the bank takes the house and they can sell it or keep it, but they can sell it. And they don't owe you the money on top of it. And they don't have the right to, come after you for more money than that. What complicates things, there's just a third thing called judicial sale, which is basically power of sale, but done through the courts. So it's more expensive, more time consuming than a power of sale. And if you start a foreclosure as a lender, if you start a foreclosure against someone who's in default, at any point that person in default can force you to go, no, I want to do judicial sale instead, which becomes a pain in the ass for the lender. So they say, well, let's just do power of sale all the time. So there's very rare circumstances where someone's actually going to try to do foreclosure. So power of sale, though, because the lender owes the previous owner the difference, the lender owes the borrower the difference on what they sell it for, or can sue them. They have a responsibility to make sure they get fair market value for the property. So that's why when you try to lowball a power of sale, they might not even counter, or they're going to counter it very high. They want to see multiple offers. They don't want to take an offer the first day that it's listed. Multiple offers, I don't mean at once. They might want to see countering back and forth. They're going to get multiple appraisals and try to get an offer, within that range of the appraisals. So they're doing a lot to cover their butts because they can be sued for something called improvident sale. Basically, hey, I defaulted on my mortgage, but you sold my house for too much money, for too little money. Now I'm suing you for the difference, or I'm suing you to not owe you the difference if it was a shortfall. So banks don't want to do that. So they're very careful. And the end result is most power of sales, they end up selling for almost market value, very close. You don't get much of a discount on power of sales. So it's not a great, unfortunately, it sounds like it's much better in the US. It doesn't end up being super great in Canada. So, yeah. I don't know if you guys have anything to add on that.
Yeah, I have the same experience. I mean, like, yeah, sometimes you can get good deals in power sales. Sometimes they just end up at market value or some subset thereof. But I did a buy one, get one deal one time on a power sale where I literally bought 2 houses for the price of one. This was owned by like a big 5 institution. And I happened to be there, right place, right time. This had sat on the market for a long time, thereby conventional market value had been reduced because nobody had bought it because it wasn't at market value. Right. And as a fiduciary, if the lender has to sell it at market value, how do you really determine what market value is? And if it sits on the market for a long time, obviously that's not what it was. So like it went down, it went down, it went down. I threw in an offer. We had to go back and forth a little bit, but I ended up with 2 houses for the price of one. I called it the buy one, get, I called it my BOGO deal. It's like buying a pair of shoes. Right. And I was able to split the lot and end up with 2 houses on 2 lots for the price of one. It was a crazy deal.
And one was one of the first tiny homes.
No,
that's a different one.
That was a different deal altogether. Yeah, this was a different property out east, like up the 401. And nice. Yeah, we got 2 for the price of one. It was a ton of fun.
Yeah,
we've dealt with sellers that are kind of just in the process of power of sale on a few occasions, and even on the real estate agency side, when we've helped list properties that are going through power of sale, what I find, like banks, when they take on a property, it's a liability. right? They want to offload that. So even with lenders, they're in the business of lending money. They're not in the business of taking over a property, putting it on the market, selling it. So I think that often what happens is, well, for in our case, we the value that they owed the lender was always less than what we were coming in at. So these were always very much encouraged by their lenders because they don't necessarily care. They want their money back. At the end of the day, the seller, they got to figure out what the difference is that works for them. So, but definitely if you're in a situation like that, it's the lender wants their money out stat for sure.
Yeah. Some people don't understand that lenders, like to your point, Alex, like that banks don't want your asset because asset management is a whole business in itself. And they lend cash, they wait for the cash to come back. They don't want the thing. Like it's like buying a property in Northern Ontario if everything you do is in Hamilton, right? It's like you have this one little property up top. And it's like this mosquito on the wall. It's just driving you crazy. Lenders don't want that asset. They don't want that mosquito. It's like a bye-bye, right? So they put it up and yeah, they got to get the most money for it. But like, that's why they don't want that house or that building because they're not built for that.
Yeah, absolutely. So Tom Popievsky asked, I'm sure you guys know him, excellent realtor as well, and an excellent house flipper and investor. He asked, in your opinion, what is the biggest risk to our real estate market?
Ooh,
It's a hard one.
that's a tough, like in what, I don't know, what could the risks be? Undersupply, oversupply, interest rates,
Inflation.
construction cost.
Yeah,
I don't want to get too like conspiratorial, but like there's a couple of like really wacko ideas that I've heard through the grapevine that scare the crap out of me. But anyway, like for one, and this might not be practical, and God damn it, I hope it never happens. But like I've heard people talking that they're trying to lobby because tenants contribute so much to a property because the rent's being so high that they're trying to gain an equity share because tenants are contributing to the mortgage pay down. And I think that that is such a bogus thing. Like honestly, it is. But unfortunately, without getting too political either, we tend to have some very skewed opinions in our current government, which I don't necessarily agree with at all. It's probably the politest I'll ever say that.
Man,
But-
think about that. That would be like owning a portion of Sobeys just because you buy your produce there.
Totally. And, you know, honestly, a bunch of it doesn't make any sense. But unfortunately, the squeaky wheel gets the oil, and there's a lot of squeaky wheels right now. And it's like, yeah, I don't necessarily think it's ever going to get to that because I do think that fundamentally we're based on a free market economy, and God, I hope it doesn't. But you know, you say like, well, that can't happen, and then all of a sudden things like that happen. It's just like, to me, when I consider what's the biggest risk that could happen, that would be one of them. But
I think construction costs are a risk for sure. I think, you know, obviously we need to create housing and so on. This type of thing, creating housing, comes from the top down, not from the bottom up. And I mean, I think as we talked about earlier, Bill 23 is important because policy will really dictate what can be built and where it can be built. And upzoning was key to that. However, bricks and sticks still cost money. There is still a fixed cost of putting together, you know, a home with 4 walls and a roof that's considered habitable in the modern society that we live in today. You go back 100 years and you look at some of these homes and you go, oh my gosh, how did people live in this? Drafty and cold and, you know, oil heat or whatever. You know, in modern times today, oil is so expensive. Well, maybe oil was the only way back then, and petrochemicals weren't that much money. Right? Insulation today is even more important because of the cost of, you know, natural resources, electricity, and so on to keep the place warm. Like it's important. Back in the day, like nothing was insulated. It was insulated with newspapers and horsehair, you know? So like things have changed over the years and they've evolved. I think construction cost is definitely a risk. And the same thing goes for skilled trades labor. I was in the skilled trades too, right? Like I'm a Red Sea mechanic, graduated from that, and then ended up in construction. And I had a full-time, you know, construction crew for the last 10 years. I employed a full-time payroll, like 30 people over the last 10 years. And then in addition to that, like hundreds of subtrades. I've slowly seen over that 10-year time period, the quality of the subtrades degrade, right? And also the volume and the amount of people that can actually do that work get fewer and fewer and fewer. And when you have that, it goes back to the supply and demand thing that we're seeing with housing. Well, if you have 100 plumbing jobs and only 10 plumbers to go around, well, the price is going to go way up. You know, if that was flipped and you had an excess of plumbing supply, the price would come down. So I think that's going to be a very real challenge from now moving forward into the housing market, whatever that might be in the next 5 or 10 years.
Yeah, both very valid points. Construction's a scary one. A funny one to think about is what if location didn't matter as much, and you know, if they ever figured out teleportation, which I don't know that that's ever going to figure out, but suddenly you don't need to live in the downtown because you can just teleport there for work. You can go live in Northern Ontario in the boot or wherever, right? So something like that would make it less interesting. I think a risk is, I think personally, I believe real estate's going to be going up for the next 30 years. Is it going to be going up for the next 100 years? I don't know. If you look at population trends, is there going to be, is there going to be a point where Canada becomes like Japan with a declining population, right? At that point, real estate's a lot less interesting. We have a ton of immigration right now, highest ever. So it's an amazing time to be in real estate. And for the foreseeable future, that's going to be the case. Is there going to be a point where people don't want to come to Canada? Are you going to, people are going to say, well, it's way too expensive. I don't want to immigrate there. I don't know. I don't know that that's ever going to be the case. But that's a risk for sure, that we'd have people leaving Canada, or at least the cities that I invest in, people leaving those cities even to other parts of Canada. So that's a risk for sure. And I agree with you, Alex, like tenant protection rules. I was reading up on this the other day about how one of the few things economists agree with is that rent control actually makes rent more expensive. It limits the supply and ends up with more expensive housing. So you have some certain people protected by it, but overall it's worse for the market overall. So rent control is worse for renters, but renters don't know that. And because of that, it's terrible for renters. It's excellent for politicians. So yeah, I think forms of rent control and tenant protection rules could be one of the biggest problems for, there's actually talks right now. I doubt it's going to happen once again, where they're trying to say, if the government's going to tax you if you increase your rent above a certain amount. So if a tenant leaves and you jack up your rent a lot, then the amount you've increased your rent, a portion of that's going to get taxed extra because you made too much money on the new tenant or something like that. So
really,
it could be some stupid rule they put in place that could be a risk for us for sure. But tenant protection rules are one. I think construction costs are insanely high. And I actually think construction costs is definitely one of the areas where the government could get involved in a lot of different ways to actually make a significant difference. But, those differences are felt over 10 years and their election terms are 4 years. So they're not going to do it. It's not going to help them get reelected for the most part. So, someone else said they'd be curious how drastic climate change might affect our real estate. That'd be an interesting one too. What a somber note to end this on. The risks, the opportunity. Actually, we should say what do you think?
Let's end on opportunities. Yeah.
Yeah. What do you think? What do you see as amazing opportunities going forward? One for me, I actually think people say, oh, it's really hard investing in the city. I'm going to sell my rentals. Great. It's hard to invest in the city. That means fewer people are going to, and there's going to be less supply, therefore more demand for my product. If the government makes it hard to build rentals, to own rentals, eventually my rentals are going to be worth a lot more money because there's going to be few of them. So pros and cons to that, but that's an opportunity I see is actually, if you're able to withstand in this province long term, I think there's an incredible amount of money to be made holding long-term real estate.
Mm-hmm.
I was going to say something similar in that regard, because I know a lot of people, especially with the rental rules becoming so crazy, or a lot of people getting burned, especially during COVID, by not getting, I'm dealing with a poor lady who we've actually decided to partner on her property, which I'm going to get to in a second, because this is an incredible strategy that I've been doing. I've done it like 4 or 5 times now. But she's owed more than $50,000 rent in arrears. And she didn't know what she was doing. It was like she got a little son who she had bought this property in order to have something sustainable for his future, education, whatever. She had this whole plan, and she just got raked over the coals. So I think that a lot of people who are have this negative taste in their mouth from real estate or rents, or inversely as well, when the market kind of went down and people had to, give up their rentals and they took a big haircut on it. Those are just opportunities, unfortunately for us, unfortunately for others. But when people aren't educated on things and they're just like, forget it, I'm done, that creates less competition effectively. And I do see that nowadays with a lot of people who are just like, they gotta step back and take a bit of a breather because we just went through a bit of a whirlwind. But if you do things consistently and you're not making rash decisions or sloppy mistakes, and you can just ride out the wave. It might not be as profitable, but once again, I don't care that my properties are worth maybe $100,000 less each because I cash flow every single month. I'm okay with that because eventually the market will correct itself. But the strategy I was wanting to just touch on quick, if I may, a lot of situations are where individuals might own a property and they don't know what to do with it and they're looking to sell it. Now, you can potentially create a really great win-win that rather than them selling it on the market, they sell it to you and you become 50-50 partners. And so we've actually partnered with the sellers on properties as they've moved on. They've could qualify for the refinance on the back end. So they've not only funded the entire renovation, we've stick handled the entire thing, we've legally duplexed it, we've put tenants in there, and then they have refinanced and pulled that capital out. And now we're 50-50 partners based on what we had agreed upon was a baseline cost of their property on the buy-in. And honestly, like those particular partners of mine would be probably the first people to like jump on a call to give us like a kudos if somebody needed like a reference or something. They're just like, it's a very creative win-win where somebody doesn't necessarily want to sell in this market, but they need to get capital out, right? There's people downsizing that maybe don't want to take $100,000 loss, but they want a certain price. And if you can make it work, it could be a really, really good win-win. So.
I'd agree. I think the big upcoming trend and opportunity in real estate from here moving forward is intensification. So, I mean, governments right now are on board with adding units. When you're adding units, your dollar cost averaging down, your cost per unit in terms of the land or the house or whatever. If a house costs $1 million and you got 2 units in it, well, it's $500K a unit, right? And if you got 3, it's 333. So I think intensification is really big. When we look back historically, and we see these buildings built in the 60s and 70s, and people go, oh, wow, grandma's bungalow, that brick bungalow that everybody wants if you're in the residential space, or those nice purpose-built concrete buildings built back 1950, 60, 70, and so on. People love those, right? Well, it was more favorable at that time to build those, kind of fell off. And now that's coming back because policy is coming back. And I think policy is really what drives a lot of these opportunities. As long as you can get your construction costs in line and your financing and all this stuff, yes, there's other constraints, but there's a lot of opportunities out there with respect to intensification and adding new units to increase the housing supply. So from my perspective, I think that's a big one.
Nice. And I think both an opportunity, but also one of the advantages of real estate is that the market is imperfect. That's one of the best things about this is that, you go buy bonds and you're trading on bonds. I mean, even it's very hard to do well because there's so much, the information is all available, trading stocks, bonds, information is all available. But in real estate, there's an asymmetry of information. You can know more than the other person, than the other buyers. You can understand your area, know what the highest and best use is for that, certain piece of land. You go look at that and be like, oh, this is the property that I bought in Ottawa. I bought that one with partners. I don't typically buy with partners, but I bought that one with partners. But it was the perfect one because the 2 driveway situation. Other people might not have seen it the same way, but to me, that's a huge value add. So I think, yeah, and just understanding values, understanding how to value properties, being better at managing renovations than others. There's so many ways that you can be better at real estate investing. And that's a huge opportunity, right? You can be better at it. So just putting in the time, learning the skill set and putting the effort, you can actually just do a better job versus it's so much harder to do a better job because you lose control when you're trading stocks. You might be really good at valuing the direction they're going to go in. I don't know enough about that, but I know that you have very little control over what happens to any particular stock. Whereas in real estate, you actually do have control. You can go, hey, I actually have an advantage in this area because I know people who can do this renovation cheaper, or I know the best way to design this property, or I know about, you know, a certain intensification rules that are changing, or this LRT was just announced, or whatever it is. So not everyone's going to know that right away. The seller may not know that when you're buying it from them, and that allows you to have, with that extra information, you have opportunities to either get a better deal than you would otherwise get, or avoid a worse deal than you would otherwise be dealing with, right? Someone else might buy across from an old dump and not know it. You go, oh, I know that's an old dump. That's going to be a bit of stigma, so it's going to be harder to sell in the future. So I'm going to have to lower the after repair value on my flip. And now this one doesn't make sense, so I'm going to pass on it because I know that, because I've done my work, understand it. So with that being said, thank you so much, guys. I'm so happy having you guys. What a wealth of information. I'm sure people got a ton out of that, and couldn't imagine a better panel. So thank you so much, guys. If you guys want to drop your contact or social media in the chat again, if anyone wants to follow you, everyone who's been watching, thank you so much for sticking around for over 2 hours. We went a little long, sorry about that. Thank you for sticking around. The replay will be sent out. The recordings can be sent out in the next few days. And there'll be some information about our guests there if you miss it here. So thank you guys so much for coming. Don't forget, we do host in-person webinars. We have one coming up in Toronto on February 7th. We have another one coming up in early February in Ottawa. And we do more, so I guess I call them webinars, but in-person meetups. So those are good ways to shake hands and meet people in person and do a little more networking. I think these are awesome. Educationally, I think going through these questions are, I love it. I think it's great. So I love hearing your opinions as well.
Thanks, Luke.
Thanks,
Yeah.
Luke.